Morning, students. Welcome you all in the second lecture of CA Final Financial Reporting classes organized by ICAI. So once again, I am faculty for the session today, and my name is Alok Garg. So students, yesterday we have discussed overview and roadmap for implementation of Ind AS. We discussed what is Ind AS, how many Ind AS are there, via which notification Ind AS have been notified, right? Then we discussed what is the applicability of Ind AS, right? What is the meaning of net worth? So all these things we have discussed yesterday, and today we are going to discuss Division 2 to Schedule 3, which provides the format of financial statements, right? And we will discuss Ind AS 1, presentation of financial statement. Ind AS 1 is the first standard which talks about presentation of financial statements, right? So division 2 to schedule 3 also prescribe the format of financial statement, and Ind AS 1 talks about presentation of financial statements. So I hope my PPT is visible to everyone, guys. So let's talk about schedule 3 first. And I'm sure that all of you are aware about schedule 3, right? So what is schedule 3? Schedule 3 is one of the schedule which is given under Companies Act 2013. Okay. Schedule 3 is provided under Companies Act 2013, right? When it was earlier Companies Act 1956, it was Schedule 6. But in the current Companies Act, it is Schedule 3. And what is the role of Schedule 3 and what Schedule 3 prescribes? Schedule 3 prescribes the format of financial statements, right? So Schedule 3 prescribes format of financial statements. Whether it provides format of financial statements for companies or for non-corporates or non-companies as well. It provides format of financial statement for companies only. Companies Act 2013 is applicable for companies, okay? So Companies Act 2013 is not applicable to non-companies. It is applicable to companies. Understood? Yeah. So friends, if I talk about Schedule 3, how many Schedule 3 are there? I mean to say, when I say how many Schedule 3, so nowadays Schedule 3 has bifurcated into multiple divisions. Okay. Schedule 3 has been bifurcated into multiple divisions. One is Division 1 to Schedule 3. Division 1. Okay. The second one is Division 2. The third one is Division 3. For example, why it is important to understand or why it is important to know how many divisions are there, because for example, if your principal or if your, let's say you are doing articleship and your principal or the chartered accountant says that Mr. XYZ, you have to prepare the financial statement of this particular company, okay? And in that case, you are just Google out Schedule 3. So you are not aware that which division Google will throw you. Okay. So first of all, we should understand how many divisions are there. Then we need to understand these divisions are applicable to which set of companies. Yesterday we discussed that Ind AS is applicable to which set of companies. For example, we discussed that Ind AS is applicable to all the listed companies, right? Then we discussed Ind AS is applicable to unlisted companies also. If that company is having a net worth is equal to 250 crores or less than or more than 250 crores, right? Then we discussed Ind AS is not applicable to non-corporate entities. Ind AS is not applicable to banking. Ind AS is not applicable to insurance, right? We discussed Ind AS is not applicable to overseas entities. We discussed Ind AS is not mandatorily applicable to SME entities which are listed in SME stock exchange. Then we discussed Ind AS is not mandatorily applicable to companies whose net worth is less than 250 crores, but they can voluntarily apply, right? If they want to apply, they can voluntarily apply that, right? So friends, Schedule 3 does not tell you that which set of standard will be applicable to which set of companies. If as per Companies Act or as per the other notification, if you have decided or it is concluded that on your company AS will be applicable, on your company Ind AS will be applicable, or your NBFC company on which Ind AS is applicable, then Schedule 3 will tell you that which division will be applicable, right? So Division 1 will be applicable, Division 1 will be applicable, Division 1 will be applicable where the companies are preparing the financial statement as per accounting standard. When I say accounting standard means Indian GAAP. I would request each one of you, please write down these things. Okay. Please keep your pen and paper ready. Please keep your notebook ready. Division 1 is applicable when the companies are preparing financial statements as per old accounting standard, as per old GAAP. Sir, whether it is relevant for CA final, from examination perspective, from curriculum perspective, it is not relevant, right? Division 2 is applicable when the companies are applying Ind AS, when the financial statements are prepared as per Ind AS. Okay. Division 3 is applicable when companies are applying Ind AS. Sir, Division 2 is also for Ind AS, Division 3 is also for Ind AS. Then what is the difference between Division 2 and Division 3? How can we know about which division has to be applicable on which set of companies? So friends, Division 2 is applicable. You remember in the last class we discussed that there are two notifications of Ministry of Corporate Affairs. One was 16 February 2015 notification, which talks about the applicability of Ind AS on companies. Then we discussed 30th March 2016 notification, which talks about applicability of Ind AS on NBFC companies, right? Right? One notification, the first notification, 16 February 2015, talks about applicability of Ind AS on companies other than NBFC companies. Notification dated 30th March 2016 talks about applicability of Ind AS on NBFC companies, right? So Division 2 is applicable on companies other than NBFC, companies other than NBFC. Sir, Reliance Industries Limited, Bharti Airtel Limited, Infosys Limited, TCS Limited, Larsen and Toubro Limited, Ultratech Cements Limited. These companies are applying which division? So these companies are applying Division 2 to Schedule 3 for preparing their financial statement. Sir, what about Division 3? Division 3 is applicable for NBFC companies which will apply Ind AS. Okay. Sir, HDFC Limited, you have taken an example in the last class for HDFC Limited. So HDFC Limited will apply Division 2 or Division 3. HDFC will apply Division 3 because it is NBFC company. Bajaj Finserv Limited, Muthoot Fincorp Limited, Royal Sundaram Finance Limited, Sriram Transport Company Limited, Sriram Transport and Finance Company Limited. So these companies, being a NBFC company, will apply Division 3 to Schedule 3. Division 3 to Schedule 3. From the CA final perspective, Division 2 is applicable. Division 2 to Schedule 3 is applicable, right? From the curriculum perspective. But from the professional and from the expert, from the professional and from the perspective of an expert, of course, you should be aware which division is applicable to which set of companies. I hope it is clear to everyone now. Division 1, Division 2, Division 3, right? Great. So friends, Division 1 to Schedule 3 was notified by Ministry of Corporate Affairs on 26 March 2014. On 26 March 2014, okay? So the Companies Act 2013 was applicable from 1st April 2014, and this Schedule 3 was notified on 26 March 2014. Okay. The Division 2 to Schedule 3 was notified on 6 April 2016. Okay. 6 April 2016. Okay. Ind AS were notified on 16 February 2015. And after 1 year, the Division 2 to Schedule 3 was notified on 6 April 2016. And Ind AS were mandatorily applicable from which year? 2016-17. Okay. Ind AS were mandatorily applicable for few set of companies. Which set of companies, guys? You remember yesterday I told you that in the phase 1, all companies whose net worth was more than 500 crores that were covered at that point of time. Okay. So I'm talking about the past. So when Ind AS were made applicable on companies whose net worth is more than 500 crores in 16-17, I'm talking about 16-17. So Ind AS were mandatorily applicable for the first time in the year 16-17, right? And hence in April 16, Division 2 to Schedule 3 was notified, right? NBFC companies. On NBFC companies, first time Ind AS were made applicable from the financial year 18-19. So the NBFC companies whose net worth was more than 500 crores at that point of time, so on those companies, first time Ind AS were applicable from the financial year 18-19, and hence Division 3 to Schedule 3 was notified by MCA on 11 October 2018, right? These are the notification date. Okay. So you should be aware if your principal will ask you to prepare the financial statement and find out Schedule 3, the relevant Schedule 3, then you need to see these notification, right? Understood? Friends, let's discuss about Division 2 more. So this was notified on 6 April 2016, but this Schedule 3 got amended from time to time, right? So this Division 2 to Schedule 3 got amended on 11 October 2018 also. This got amended 11 October 2018. Sir, on 11 October 2018, Division 3 was notified. But apart from Division 3 notification, on 11 October 2018, some changes were made in Division 2 to Schedule 3 also, right? So amendment is also relevant. And once again, this Division 2 to Schedule 3 was once again amended on 24th March 2021. Very important, very relevant. And there was a huge amendments in Division 2 to Schedule 3, Division 3 to Schedule 3, and Division 3 was also amended on 24 March 2021. Division 1 was also amended on 11 October 2018 and 24 March 2021. This 24 March 2021 amendments are very important. So friends, as on date, if I talk about Division 2 to Schedule 3, which is important from the CA final perspective, Division 2 to Schedule 3 is applicable on companies other than NBFC companies on which Ind AS is applicable, right? Sir, whether Division 2 to Schedule 3 will be applicable to insurance company? Answer is no. Why? Because on insurance company, Ind AS are not applicable as of now. Okay. They cannot apply even voluntarily. Okay. Sir, whether Division 2 to Schedule 3 is applicable to banks? Answer is no. Why? Because they cannot apply Ind AS even voluntarily. I think it is okay so far. Division 2 to Schedule 3 was notified by Ministry of Corporate Affairs on 6 April 2016, and it got amended on 11 October 2018, and it got again amended on 24th March 2021. And on this date, there was huge amendments in all the divisions of Schedule 3. So students, I think the context is clear to all of you. Students, please let me know if you have any issue. Students, please let me know if you have any questions so far. Yeah, great. Now let's talk more about financial statement. Then we will move into the more deeper and we will more dive into the nitty-gritties and complexities of division 2 to schedule 3. So friends, please tell me what are the elements of the financial statement. Please tell me what are the elements of the financial statement. Elements of financial statement. Mohammad Ishan has a question. Sir, why Ind AS not applied on banking and insurance company? Ishan, initially Ind AS was made applicable to banking company, okay, initially. But banks were not ready to implement Ind AS due to Ind AS 109. In Ind AS 109, when you read financial instruments, you will find that in Ind AS 109, for the provisioning of loans, for the provisioning of financial asset, there is a very stringent model of expected credit loss. Okay. And banks were not ready to implement Ind AS. Banks were not ready to implement that financial instrument standard because the provisioning norms as per Indian accounting standard are different from the provisioning norms which is given by RBI, right? So hence RBI is regularly working on aligning the Ind AS provisions with the RBI existing provisions on banks, and hence RBI deferred sine die implementation of Ind AS on banking companies. It is not like that Ind AS will not be implemented on banks. Ind AS will be implemented on banks, right? Initially, it was made applicable, but it got deferred, and it got deferred sine die. Okay. On insurance companies, again, on insurance companies, Ind AS were made applicable, right? But in global environment, a new standard came, which will be applicable from 2023, right? A new standard on insurance contracts, IFRS 17 has came, right? Which is not yet made applicable. It will be applicable from 2023. And in India, ICAI is working on Ind AS 117, which is a counterpart new standard on insurance contracts. And hence, this new standard Ind AS 117 is different from Ind AS 104, existing standard on insurance contracts, right? So that is why Insurance Regulatory Development Authority, IRDA, has deferred implementation of Ind AS on insurance companies. They have said first insurance company will implement Ind AS 104, then the new standard will come, then they will implement new standard. So why not to implement Ind AS on insurance companies in one go when this new Ind AS 117 will come? So probably on insurance company, Ind AS will be applicable from next year. Probably the notification has not yet come, but probably it will made applicable from 1st April 23, or it will be made applicable from 24, right? Ishan, I hope I have answered your query. Yeah. So I have asked what are the elements of financial statement, and Jyoti has replied, Ram Kumar has replied, right? So they have replied balance sheet, P&L, cash flow statement, statement of changes in equity, and notes to accounts, right? Mani Jaina has also replied notes to accounts. Syed Aisha has replied assets and liabilities, capital. So guys, I have asked elements of financial statement, Panch Tattva, what are the elements, right? I have not asked component of financial statement. Element of financial statement is not balance sheet P&L. Element of financial statement is well answered by Syed Aisha. Elements of financial statement are there are three elements in balance sheet: asset, liability, and equity. Asset, liability, and equity. There are three elements of balance sheet, and income and expenditure. Income and expenditure. Two element of P&L. And please take any name in the field of accounts, any item, you will find that this item will fall into these five elements. Equity share capital. What is that? Equity. Sir, loan given. What is that? Asset. Sir, cash deposited into bank. What is that? Asset. Okay. Sir, the company has paid salary. Salary. What is that? Salary is an expenses. Right. Sir, we have received dividend income. Dividend. What is that? Income. Right. Sir, the company has taken a loan from bank. What is that? Liability. Okay. So whatever item will came into your mind, it will take the shoes off, either asset, liability, equity, income, or expenditure. Right. So there are 5 elements of the financial statement. Now, what are the component of the financial statement? And when I'm saying component of financial statement, the component of financial statement is given under Ind AS 1. It is given under Ind AS 1. Right? So friends, whatever you have replied, right? And Sai has also given the right answer: asset, liability, expense, income, and equity. Sai. Okay. So friends, whatever you have replied, now that was more from the perspective of component of financial statement. So what are the component of financial statement? All of you has said that, sir, component of financial statement is balance sheet, right? We all know that balance sheet is one of the important component of financial statement, and balance sheet shows statement of financial position, right? Second, the component of financial statement is statement of profit and loss, right? Statement of, and the word is not profit and loss account. Okay. So being a CA final students, the words are very important. The nomenclatures are very important. Okay. In our layman language, right, we said that P&L account. So although in terms of, regular conversation or in terms of bolchal ki bhasha, it is okay. But while drafting the financial statement, while preparing the financial statement, the correct language is, the correct word is statement of profit and loss. It is not profit and loss account, or it is not a statement of profit and loss account, right? It is statement of profit and loss. Okay, sir. Statement of profit and loss. Then fourth, statement of cash flows. Statement of cash flows. Fifth, notes to accounts. Notes to accounts. Sir, you have written 1, 2, 3 blank, 4, 5. Okay. So students, you all know balance sheet. Even we were preparing the balance sheet for companies which were preparing financial statement as per old accounting standards. We know statement of profit and loss. Yes. We know cash flow statement or statement of cash flows. And of course, we were preparing notes to accounts, including accounting policies, right? And of course, we are also providing comparative information for at least 1 year. Am I right? So these 4 components were there in accounting standard scenario as well. But what is the third component? What is new? The new is a statement of changes in equity. 2, 3 students have also replied or responded when I asked about elements. A statement of changes in equity, right? A statement of changes in equity. So this is a new component under Ind AS, which was not there under accounting standards. Okay. A statement of profit and loss. So sir, is there anything new in statement of profit and loss? Can anyone tell me what is new in statement of profit and loss? So we all know in statement of profit and loss, there is income, there is expenses, there are profit before tax, there is a tax expenses, then there is a profit after tax, right? So our old P&L, which were prepared under accounting standard division 1, it ends on profit after tax, right? But under Ind AS profit and loss, it is an extended version of statement of profit and loss. When you will compare the format of P&L under division 1 and division 2, you will find the format of P&L under division 2 is much longer, much bigger, right? Much expended. Why? And yes, once again, Soham, Ishan, Rohan, Radhika. So you have replied very right. Right answer. Why? Because of comprehensive income, other comprehensive income. There is a new concept of other comprehensive income into Ind AS, right? So statement of profit and loss, there is a new concept of other comprehensive income, OCI. I will call statement of changes in equity as a SOCI, SOCIE, and other comprehensive income as OCI, other comprehensive income, right? So students will talk about other comprehensive income when I'll start Ind AS 1, right? So balance sheet, statement of profit and loss, including OCI, statement of changes in equity, right? It's again a new statement. Sir, statement of changes in equity, what is that? As the name suggests, equity. Equity means equity shareholder funds. Okay. So statement of changes in equity talks about what is the movement in the equity share capital and what is the movement in the other equity, which is known as a reserves and surplus, right? In our old scenario, division 1 or accounting standard scenario, in shareholder funds, equity share capital were there and reserves and surplus were there. The name of the reserves and surplus has been changed to other equity in division 2 to schedule 3, right? Is it clear? So statement of changes in equity gives the movement in equity share capital and movement in other equity. Sir, are we providing the movement in our old financial statement also while preparing the FS under accounting standard? Yes. In the notes to accounts, we were already providing the movement of equity share capital and movement of reserves and surplus. When I say movement, I mean to say reconciliation. What is my opening? What is the addition? What is the deletion? What is the closing, right? For example, opening retained earning, add profit during the year, less dividend paid, or transfer to general reserve, closing retained earnings. So this is known as a movement or reconciliation. Now it become an important component of the financial statement. When I say component, it means like balance sheet, auditor is signing the balance sheet and board of director is signing the balance sheet. Likewise, this page of statement of changes in equity is also going to be signed by board of directors and chartered accountant. Okay. I hope it is clear to all of you, friends. So friends, let me show you one of the financial statements so that you will have an idea that why it is known as a component of the financial statement, right? Let me know if the annual report is visible. So I'm showing you annual report of a listed company, Bharti Infratel Limited. Is it visible? I hope it is visible to all of you. Yeah. If you see, so friends, I was talking about components. So you can see balance sheet is there, right? So current period, comparative period. And in in division 2 to schedule 3, in Ind AS financial statement, asset come first, then equity, then liability, right? Then equity, then liability. And all the assets and liabilities has to be bifurcated into current and non-current, right? Which we are already aware. The same work we were doing in our old financial statement also, non-current, current, right? Non-current liabilities, current liabilities. Okay, sir. And let me show you in our accounting standard balance sheet, we were using equity share capital. Okay, sir. But instead of reserves and surplus, here we are using other equity. Yeah. Then coming to the statement of profit and loss, which is a second component, you can see it is signed by the Deloitte, it is signed by the board of directors, right? And the management. Then the second component is statement of profit and loss. Sir, in our old P&L, we were showing income, expenses, okay, taxes, profit for the year, and our old P&L ends here, right? But Ind AS P&L is expended P&L, and you can see other comprehensive income. This is a new insertion under Ind AS P&L, right? Again, it is signed by the auditor and it is signed by the board and the management. Sir, this is the new component, statement of changes in equity. And as I told you, statement of changes in equity, you can see a equity share capital, and there is no movement, and hence the company has given for the comparative year and current year opening, closing, because the share capital is static. Then in other equity, there is a reserves and surplus and other comprehensive income. Other comprehensive income is also a reserve, okay? But this has to be shown separately. So other equity. And you can see that after P&L, this is one component, and this component has also signed by the auditor and management and board, right? Right. Then the fourth component is statement of cash flows, right? And we all are aware about statement of cash flows. It is current year, it is comparative year. Yeah. It is again signed by the auditor, and it is signed by the directors and management. Then notes to accounts, notes to the financial statements, right? Which includes your corporate information, basis of preparation, accounting policy, balance sheet related notes, P&L related notes, and other notes as required by the Indian accounting standards. Okay. So I hope it is clear to all of you, friends. Let's move on to the presentation once again. So we have talked about the component of financial statements. Okay. And now let's talk about the applicability of division 2 to schedule 3. So one of the student has asked, sir, whether banks can apply division 1? Yes. So although division 1 is not mandatory because the banks are preparing their financial statement as per accounting standards, okay? And this division 1 is not mandatorily applicable to banks or electricity companies, right? But no any format is defined in their regulations, and hence normally banks and these kind of companies are applying division 1 to schedule 3, okay? Are applying division 1 to schedule 3. Clear? Is it clear? Yeah. So division 2, it is clear. So what are the difference between the component of the financial statement in our old division 1 or in our old AS scenario? There was no other comprehensive income, there was no extended version of P&L, and there was no statement of changes in equity. These two are the new things under division 2 to schedule 3. Yeah, I hope it is clear to all of you. Let me know if you have any query so far. So let me look at the query box if anyone will have any query. No. So there were 3-4 queries which I have already responded. Great. Let's move on, friends. So now let's understand the universe of schedule 3. And friends, I have summarized the entire schedule 3. I mean to say division 2 to schedule 3 or entire schedule 3 in 16 questions, in 17 questions. In these 17 questions, entire schedule 3 will be covered in these 17 questions. This is entire schedule 3. And I am not only talking about from the examination perspective. These 17 questions will also important for the professionals who are chartered accountants and who are into practice or who are doing a job in the industry, right? Let's discuss one by one. And I would request each one of you, please keep your pen and notebook ready, right? And wherever I'll tell any important concept, please write down. First question, schedule 3 is applicable to companies only or it is applicable to non-corporate as well? Guys, tell me. Schedule 3 is governed by Companies Act, and Companies Act is applicable to companies only or it is applicable to non-corporate as well? Tell me. It is applicable to companies only, right? Schedule 3 is not applicable to non-corporate. It is applicable to companies only, right? Companies only. It is applicable to companies only, right? How many divisions to schedule 3 is there and what is the applicability? Guys, tell me quickly. How many divisions to schedule 3 are there? 3 divisions to schedule 3. 3. There are three divisions to Schedule 3, three divisions. And what is the applicability? Tell me what is the applicability. Division 1 is applicable to the companies which are preparing their financial statement as per accounting standard. Division 2 is applicable to the companies which are preparing their financial statement under Ind AS, other than NBFC companies. Division 3 is applicable to NBFC companies which are preparing their financial statement as per Ind AS. Okay, clear? So division 1 is for AS, division 2 is for Ind AS, right? Division 2 is for Ind AS. Clear? Division 1 AS, division 2 and division 3 Ind AS, right? But division 2 non NBFC, division 3 NBFC. Clear? When did division 2 to schedule 3 was notified? I have just discussed few minutes back. Yeah. When did division 2 to schedule 3 was notified? Division 2 to schedule 3 was notified on 6 April 2016. Whether schedule 3 got amended, whether schedule 3 got amended post originally notified? Yes. If yes, when and when was the major amendment happened? Have I told you? Yeah. Yes. Let's talk about division 2 only. Yes, it was notified. Yes. And when was the major amendment happened? So yes, it was notified on 6 April 2016 and it got amended also. There were two amendments, 11 October 2018 and 24th March 2021. And the major amendments happened on 24th March 2021. Yes. So major amendment was there on 24th March 2021. Whether Schedule 3 is applicable to standalone financial statement or it is also applicable to consolidated financial statement. Guys, what is your view? And the answer is same. The answer is same. Answer is same like division 1 to schedule 3. Whether division 1 will be applicable to standalone or it is also applicable to console. The same answer goes to division 2 also. Girish, it is not 16 April, it is 6 April. Yes, you are right. It is applicable to both. Whether requirement to schedule 3, whether requirement of schedule 3 needs to be strictly followed, or if there is any requirement of Ind AS and Companies Act 2013, can the schedule 3 requirement needs to be modified? Friends, tell me what will be your answer. For example, in schedule 3, there was a requirement to disclose CSR, corporate social responsibility, right? In schedule 3, there was a requirement to disclose CSR in the notes to accounts, and schedule 3 has given some disclosures. And for example, tomorrow Companies Act got amended, section 135 or related CSR rules got amended, and it needs a change in the disclosure the way it was given in schedule 3. So tell me whether that disclosure will be given only or the disclosure needs to be modified. Tell me, guys. Or for example, there is a requirement of division 2 to schedule 3, and there is a different requirement of Ind AS, or as per the requirement of Ind AS, the disclosure needs to be modified, right? So my question is whether the requirement given by schedule 3 is required to be strictly followed, or it can be modified. It needs to be modified due to the requirement of Ind AS or Companies Act or other regulations. You are right, Muhammad Ishan. You are right, Srishti, Parag Jain, Sai, Mr. Ramkumar. You guys are right. Okay. So if there is a requirement of Ind AS and Schedule 3, sorry, Ind AS and Companies Act or other regulation, the requirement of Schedule 3 needs to be modified, right? It is not required to be strictly followed as it is. It should be modified. It needs to be modified. Please write down. It needs to be modified. If there is a conflict between Schedule 3 and Ind AS, which will prevail? For example, Schedule 3 is giving a disclosure, X disclosure, but Ind AS does not prescribe the disclosure. Okay, Ind AS prohibits the disclosure. In that case, which will prevail? Whenever there is a conflict between Ind AS and Schedule 3, whether Ind AS will prevail or Schedule 3 will prevail. Guys, tell me who will prevail. If there is a conflict between Schedule 3 and Ind AS will prevail. Friends, please write down Ind AS will prevail. It is written under Schedule 3 only, or guidance note to Schedule 3 only, right? When you read Division 2 to Schedule 3, or when you read the guidance note issued by ICAI on Schedule 3, Ind AS will prevail. When you read your study material, you will find that Ind AS will prevail. Okay, clear? Schedule 3 is also part of Companies Act, and Ind AS are also part of Companies Act. Ind AS are also notified under Companies Act, Companies Ind AS Rules 2015, Section 133 of Companies Act 2013, right? Ind AS will prevail. I hope you guys have written these all questions and answer. So, Sri Vidya, Pankaj, Grish, Parag, Hari, Manav, Srishti, Soham, Srishti. So you guys have given a right answer. Yes. So let's move to the next question. So we have covered 7 questions here on Division 2 to Schedule 3 or Schedule 3, right? All the division. Whether any act or regulation requires specific disclosure to be made in the financial statement of the company, whether it is required to be made in addition to those required under Ind AS Schedule 3. So guys, for example, whether any act or regulation requires specific disclosures. For example, it is a listed company, okay? And in listed companies, SEBI listing obligation and disclosure requirement rules will be applicable. SEBI LODR will be applicable, right? For example, under MSMED Act, there is a requirement of some MSMED provisions as well to be disclosed in the notes to accounts. So if any act or regulation requires a specific disclosure to be made in the financial statement of the company, whether it is required to be made in addition to those required under Ind AS Schedule 3, or it should not be given. Of course, it has to be made, right? If there is any specific requirement, any specific disclosure is required by any act or regulation, it has to be made in the financial statement of the company, right? So the disclosure needs to be given in addition to what is given in the Ind AS Schedule 3. So friends, even Schedule 3 says that whatever is prescribed under Schedule 3, that is a minimum requirement. That is not the maximum requirement. That is a minimum requirement, okay? It is not a maximum requirement. It is a minimum requirement. If there is any additional requirement by Ind AS or any regulation, that requirement needs to be followed in addition to Division 2 to Schedule 3. Clearly? It is clear or not clear? Yes or no? So friends, if there is any additional requirement of Indian accounting standards, if there is any additional disclosure requirement of Indian accounting standard, for example, related party disclosure, for example, contingent liability, actuarial valuation disclosure, and these disclosure has not been given in the Schedule 3, right? So when you see Schedule 3, the balance sheet format is given, the P&L format is given, statement of changes in equity is given, and the balance sheet and P&L notes has been given. But accounting policy is not given there. Related party disclosure is not given there. The format relating to related party disclosure. Contingent liability capital commitment is not given there. Actuarial valuation disclosure is not given there. Segment reporting disclosure is not given there. Right? So friends, in this case, what we will do, whether we will not give these disclosure or we have to give this disclosure as required by Ind AS in addition to what is given under Schedule 3. Yes, you all are right. You all are right. We have to provide the disclosure. So Srishti, in question number 8, my question was, if any act or regulation requires some specific disclosure, whether those disclosure needs to be made in addition to the disclosure required under Ind AS Schedule 3. For example, corporate social responsibility, right? Let's say Schedule 3 talks about 3-4 disclosure for CSR. But Companies Act requires more disclosure, right? So in that case, more disclosure needs to be given. For example, Srishti, if you read any financial statement, you must have seen there is a disclosure relating to MSMED Act, Section 22 of the MSME Act, right? And there are 5-6 disclosure for MSME Act, okay? So under Division 2 to Schedule 3, this disclosure regarding MSME Act was not there prior to 11 October 2018. But companies were giving that disclosure, right? Why? Because it is a requirement of MSMED Act 2006, right? So the question was whether you need to blindly follow Schedule 3 as it is, or you need to see if there is any requirement, any specific disclosure requirement of any act, regulation, Ind AS. So of course, those requirements is also needs to be followed in addition to whatever is given under Ind AS Schedule 3. For example, you will say that, sir, Schedule 3 gives us format for financial statement, and in the format, the related party format is not given. The contingent liability format is not given. The segment reporting format is not given, for example. So what you will do? You will not give this disclosure. You have to give this disclosure. Why? Because the Schedule 3 itself says that the requirement given under Schedule 3 is a minimum requirement. If there is any additional requirement by any act, regulation, or Indian accounting standard, the additional requirement needs to be followed as per the act, regulation, or Ind AS. If there is any conflict between Schedule 3 and Ind AS will prevail. If there is any additional requirement by any act, regulation, or Ind AS, the disclosure needs to be modified accordingly, right? I hope it is clear to you, Srishti, now. Okay. Which component of financial statements format is prescribed by Schedule 3? Tell me. So friends, I have given you 5 components. So which components format has been prescribed under Schedule 3? So balance sheet is prescribed under Schedule 3. Okay. P&L is prescribed under Schedule 3. Statement of changes in equity is prescribed under Schedule 3. Statement of cash flow is not prescribed. It has to be prepared as per Ind AS 7. Notes to accounts is prescribed under Schedule 3, but it is partial. If there is any additional notes to accounts, it has to be followed as per Ind AS and other act or regulation, right? Is it clear? So balance sheet format is given, P&L format is given, SOC format is given, and notes to accounts partial. Okay. Why I am saying partial? If there is any additional requirement of Ind AS, that has to be followed. Any additional requirement of act or regulation, that has to be followed. Clear? Is it clear, guys? Yes. Point number 6. So point number 6 was, if there is some disclosure aspect given under Schedule 3 and the act requires to modify that disclosure, for example, corporate social responsibility, the CSR disclosure has been given under Schedule 3, but for example, tomorrow there is an amendment in CSR. So whether you will modify the disclosure or not. For example, Schedule 3 will not get amended, but CSR rules get amended, and it needs to modify those disclosure. So whether those disclosure needs to be modified or not, yes, it has to be changed, right? So whatever you have to do, it has to be in synchronization with the particular act, regulation, Ind AS, as well as Schedule 3, right? Thank you, Rahul. Thank you for your feedback. So Manav, I hope you have understood now. Yeah. So friends, you have understood regarding notes to accounts. In notes to accounts, there are a lot of notes to accounts which is not given under Schedule 3, which has to be given as per Ind AS, right? Or other act or regulation. Question number 10. Whether the item in the balance sheet needs to be bifurcated into current and non-current. Is there any guidance given in Schedule 3 regarding that? Guys, is there any guidance given in Schedule 3 regarding that? Tell me. Tell me, friends. Any guidance is given or not given? Yeah? Yes or no? So whether the items needs to be bifurcated into Schedule 3 or not, items needs to be bifurcated in division 2 to Schedule 3, the balance sheet item needs to be bifurcated into current and non-current, yes or no? Yes, it has to be bifurcated. Okay, it has to be bifurcated. Okay, yeah. So let me show you the balance sheet format. Although I have shown you the live balance sheet of a listed company, this is the balance sheet, and when you see the balance sheet, you can see non-current asset. The asset has been bifurcated into two parts: non-current assets and current assets, right? So the entire balance sheet has to be bifurcated into current and non-current, into current and non-current. Liabilities, non-current liability and current liability. And your equity will not going to be bifurcated into current and non-current, right? Equity is an equity. So asset and liability has to be bifurcated into current and non-current. So is there any guidance regarding current and non-current in your Schedule 3? So friends, the guidance on current and non-current classification is given under Ind AS Schedule 3 as well as Ind AS 1. Para 66 of Ind AS 1 also prescribes when an item has to be classified as current, when an item has to be classified as non-current. Okay, understood? And the same guidance is given under Ind AS Schedule 3 also. So let's discuss what is current and what is non-current. It is given under Ind AS 1 also. So let's discuss here. An entity shall classify an asset as current when it expects to realize the asset or intends to sell or consume it in its normal operating cycle. In its normal operating cycle. What does it mean, guys? What does it mean? Yeah. An asset as current when it expects to realize the asset. It expects to realize the asset or intends to sell or consume it in its normal operating cycle. Okay. For example, you have given a loan to a company, right? And you expect that you will be able to receive the loan. You will be able to realize or receive the loan within 1 year or within normal operating cycle, right? Within 1 year or within normal operating cycle. When you see point number C, the point number C talks about it expects to realize the asset within 12 months after the reporting period. So what is the meaning of operating cycle? The meaning of operating cycle means when the cash will be converted into the cash. For example, you have purchased a raw material. Okay. So purchasing of raw material has taken 3 months. For example, you need to acquire this raw material from China, and it will take around 3 months to reach the raw material from China to India, right? Then you need to process the raw material to convert it into the finished goods. It will take another 3 months to convert that raw material into finished goods. So 3 plus 3, 6 months. Then you need to sell the finished goods. Normally it will take around 6 months to sell that finished goods. So 6 plus 6, 12 months. And when you sell the goods, normally it has to be sold out on credit basis, right? Probably the company is into B2B business, business to business model business, and it will take around 6 months to sell that goods, and it will take around 3 months to realize the money. So when you expend cash and when you realize the cash, the period was 3 plus 3, 6 months, 6 plus 6, 12 months, 12 plus 3, 15 months. So in this case, the normal operating cycle of the company is 15 months, right? So if you expect to realize the asset within 15 months, or you expect to consume the asset within 15 months, or you want to sell that asset within 16 months, within 15 months, then it has to be classified as current assets. Or if normal operating cycle cannot be determined, then the standard says that Ind AS 1 says that you have to take a period of 12 months, right? Clear? So if any asset is expected to be realized, intend to sell or consume within normal operating cycle or within 12 months after the reporting period, it has to be classified as current asset. Otherwise, it will be classified as non-current asset. Or it hold the asset primarily for the purpose of trading. So you have purchased the investment for the purpose of trading, for the purpose of selling. Although you were not be able to sell within 12 months or within operating cycle, but your primary objective is to trade the asset. For example, when you see the financial statement annual report of Bharti Infratel Limited for the financial year 16-17, you will find that they have stated their huge portfolio of investment as a current investment. Why? Because their intent was to trade. Their intent was to sell those investment. Or inventory. Inventory doesn't matter. The companies are not able to sell the inventory within 1 year from the reporting period, but inventory will always be classified as a current asset. Am I right? Why? Because inventory is hold primarily for the purpose of trading. Inventory's intent is for the trading. Or the asset is cash or cash equivalent. Asset is cash or cash equivalent. So cash on hand is of course a current asset. Okay. Cash at bank is a current asset. So cash or cash equivalent, where the cash equivalent is defined, please write down. Cash or cash equivalent is defined under Ind AS 7. It is not defined under Ind AS 1. It is not defined under Schedule 3. So friends, let's discuss one more question here. If any word or terminology has been used under Schedule 3, from where you take the meaning of that terminology? Have you got my question? If any word or any terminology have been used in Ind AS Schedule 3, from where you take the meaning of those terminologies? For example, in this Schedule 3, related party word has been used, control word has been used, subsidiary word has been used, significant influence word has been used, cash or cash equivalent word has been used. So from where you will get the meaning of these words, these terminologies? So Schedule 3 itself says that for getting the meaning of these words or terminologies, you have to refer Indian accounting standards. You have to refer Indian accounting standards, right? So like cash or cash equivalent has been defined under Ind AS 7. Okay. Clear? So cash or cash equivalent means any item, any asset which can be quickly realized into the non amount of cash within short period, which is 3 months, right? Is it clear? So these things has to be classified as a current asset. An entity shall classify all other asset as non-current. So whatever is not current is classified as non-current, right? So we have discussed about operating cycle as well. We have discussed about, right? Let's move on. Is it clear, friends? Is it clear? Let me know if you have any query so far. Just a minute. Yeah. So what is meant by liability? Current liability same. When it expects to settle the liability in the normal operating cycle. When it expects to settle the liability in its normal operating cycle. When it hold the liability primarily for the purpose of trading. When the liability is due to be settled within 12 months, operating cycle or within 12 months. Okay. Or it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. For example, for example, the company does not have any unconditional right to defer settlement of the liability. So I'll discuss one example here. Friends, tell me one thing. For example, provision for leave encashment, right? You must have seen the provision for leave encashment in the balance sheet. For example, I'm working in a company and my outstanding leaves are 60 days, okay, as on 31st March 2021. And in 21-22, my all leaves are carry forwarded. And in 21-22, I have gone for a leave of, let's say, 70 days, leave of 70 days, leave of 2.5 months. In this case, the company has to give me a salary for 2 months, salary of 60 days. Why? Because I already have 60 days leave in my hand. 60 days leaves in my hand. Okay. So friends, the company cannot say that you cannot take a leave of 2 months. Okay. For example, because I have a leave for 2 months. So if I am taking a leave due to some emergency for a period of 2 months, the company has to give me a salary. Why? Because I have an outstanding leave of 2 months. So the company does not have any unconditional right to defer settlement. Okay. Company cannot say that I will adjust your leave in the next year. So right now I'll deduct your salary. Company cannot say that, right? So in this case, the leave has to be classified as the leave has to be classified as current asset. The entire leave has to be classified as current asset. Okay. Let me show you the real life example here. Let me show you the real life example. Please let me know if Bharti Infratel annual report is visible to you guys. Please let me know if it is visible to you guys. Is it visible? Is it visible, friends? Yeah. Okay. Let's look at the accounting policy here. Yes. Please see that. Please look at this accounting policy. The company provides other benefit in the form of leave absences and long-term service awards. The employee of the company are entitled to compensated absences, means leave encashment, based on the unavailed leave balance. The company record liability based on the actuarial valuation computed under projected unit credit method. Actuarial gains and losses are immediately taken to the statement of profit and loss and are not deferred. The company presents the entire leave encashment liability. The company presents the entire leave encashment liability as a current liability in the balance sheet, since the company does not have an unconditional right to defer its settlement for more than 12 months after the reporting date. Is it clear to all of you? Yeah. You can see the practical real life example. Is it clear? Yeah. You can see that the leave encashment has been shown, the entire leave encashment has been shown as a current liability. Why? Because the company does not have any right to defer the settlement in future. Okay. Clear? So let's move on. So friends, now again coming back to the PPT. So whether the item in the balance sheet needs to be bifurcated into current and non-current, answer is yes. Yes. Is there any guidance given in Schedule 3 regarding that? Answer is yes. Current and non-current has been defined under Ind AS 1 as well as Ind AS Schedule 3. Right? What is the balance sheet P&L SOC format in Schedule 3? What is the balance sheet P&L and SOC format in Schedule 3? Okay. So the format in balance sheet, P&L and SOC format. I have told you that the notes to accounts are partially given. The cash flow format has not been given. And what is the format which is given in the Schedule 3? Let me show you that format. And we will talk more about that when gradually we will move on. So Rahul is asking, sir, please explain unconditional right to defer. So Rahul, it means that in the example which I have taken for the leaves, for example, I have 60 unavailed leave balance in my hand. And if I'm taking a leave of 70 days, so the company cannot defer the settlement of 60 outstanding leaves. Why? Because the company does not have any unconditional right to defer. Any unconditional right to defer, right? The company has to settle my 60 leave balances with my absences, with my leaves. Okay. There is no contract. If the company will contract with me that in a particular year you will take only 30 days leave, your only 30 days leave will be adjusted against the outstanding balance and remaining will be deducted from the salary. In that case, the company has a unconditional right to defer the settlement beyond 30 days. But in this case, the company does not have any unconditional right to defer the settlement beyond 30 days. Okay. Is it clear? Is it clear? Yeah. Sumit is asking whether operating cycle is fixed for entire year or what if it changes year to year. Sumit, the operating cycle may be changed from one year to another year. It may be changed. Okay. Clear? If you cannot determine or identify the operating cycle, then it has to be taken as 12 months. Yeah. So guys, we'll talk about balance sheet P&L in SOC format later on, but let's discuss question number 12. Then we will move to the format of the Schedule 3, balance sheet P&L and SOC. Whether any rounding of guidance is given in Schedule 3. If yes, what is the provision? What is the provision? So guys, tell me whether the company is required to round off the numbers in financial statement as per Schedule 3, or for example, the in the balance sheet, the balance of property, plant and equipment is, let's say, 50 crores, 20 lakhs, 521. So whether this entire number has to be written or it has to be rounded off in some units. What is your view? Answer is yes. The guidance is given under Schedule 3, right? Rounding of guidance is given under Schedule 3. And what is the provision? Let's discuss the provision. Yes. What is the provision? This is the provision. So friends, first of all, why rounding off is important? For example, there are big companies, right? For example, the company is having a revenue of, let's say, revenue of 521 crores, 25 lakhs, 56,521. So do you think this number is readable? Do you think this number is readable? I have taken a very small number. If you will go to the big listed companies, Bharti Airtel Limited is having a revenue of 95,000 crores. 95,000 crores. Reliance is having a revenue in lakhs and crores. The companies are having a revenue in lakhs of crores, thousands of crores. Bharti Infratel is having a revenue of, Indus Tower is having a revenue of 30,000 crores. Do you think that number is readable? 30,000 crores. 30,000 Then for crores 1, 2, 3, 4, 5, 6, 7. Do you think this number is readable? Can a user of the financial statement, probably he is not a chartered accountant, probably he is not from the commerce background, can he quickly will be able to read the number? Whether that financial will be friendly? Yeah, guys, answer is no. If I'll say instead of writing this 521 crore 25 lakh 56,521, if I will write 521.25 crores, whether it is more readable, whether it is more understandable, answer is yes. So friends, in division 2 to schedule 3, in division 2 to schedule 3, this rounding off is mandatory. Rounding off is mandatory. Rounding off is compulsory, right? It says that the company shall round off the number in the financial statement. But what is the guidance for rounding off? If the total income, what is meant by total income? Total income means revenue from operations, revenue plus other income is known as a total income, is known as a total income, TI, total income. Okay. If revenue from operations plus other income is less than 100 crore rupees, if revenue from operations plus other income, the total is less than 100 crore rupees, then the numbers needs to be rounded off to the nearest 100, nearest 1000, lakhs or millions or decimals thereof. So guys, if that revenue is 100, if the revenue is less than 100 crores, then the numbers needs to be rounded off in the unit less than crores. And what is that unit? In the nearest 100, in the nearest 1000, in the nearest lakhs or millions. Million means 10 lakh, right? For example, if you will see the financial statement of Bharti Infratel Limited, the numbers are rounded off into the numbers are rounded off into the millions. If you see the balance sheet, the numbers are rounded off in the millions. Okay. Amount in millions of Indian rupees, amount in millions of Indian rupees, right? So 50,535 million. What does it mean? 5,053 crores. It means 5,053 crores. So the company has decided to round off in millions. Okay, right? Is it clear? So guys, if the total income is less than 100 crores, then the number needs to be rounded off into the nearest 100, 1000, lakhs or millions or decimal thereof. If the total income is more than 100 crore rupees, 100 crore rupees or more, then the rounding of units should be nearest lakhs, millions or crores. If the total revenue is more than, total income is more than 100 crores, then you don't have any option to round off in the unit less than lakhs. Okay. So then it should be lakhs, millions or crores. For example, 521.25 crores, 521.25 crores. Okay. Is it clear? 521.25 crores. I hope it is clear to all of you guys. Yeah. Yes. So mandatory. It is a mandatory requirement to round off the number in the financial statement. Yes, Srishti, you are right. Okay. So whether rounding off is guidance is given in schedule 3, yes. What is the provision we have discussed? The provision is on the basis of, you have to see what is the total income. If it is less than 100 crores, less than 100 crores, then it has to be rounded off into the nearest 100,000, lakhs or millions. If it is 100 crores or more, then lakhs, millions or crores. Okay. From where the meaning of the terms given in schedule 3 needs to be referred, like related party, control, associate, PPE, etc., etc., cash and cash equivalent. It has to be referred under Ind AS. You need to see Ind AS for having the meaning of the terms used in division 2 to schedule 3, right? Okay. We have done all the discussions as per division 2 to schedule 3, which is applicable to you guys. I hope it is clear to all of you. Whether any threshold of materiality is defined in schedule 3. So friends, The materiality is defined in Schedule 3 and materiality is defined in Ind AS 1. But it is a subjective definition. It says that any item which influence any item, the omission, the misstatement or obscuring. So if you are not giving the information, or if you are giving the wrong information, or you are giving the information but in a scattered way, so that one cannot be able to link or one cannot be able to understand. If you are not giving an information, I mean to say hiding an information, you are giving a wrong information, or you are spreading or scattering the information, and it will resulting into, or it will influencing the decision making capacity of the user of the financial statement, then it will be considered as a material item. This is the definition given in Ind AS 1, and this is the definition given in the Schedule 3, right? For example, Srishti wants to invest in a company, in a textile company, right? So there is a two companies, company A and company B, company A and company B, right? So everything is same. The net worth is same, the financial position is same, turnover is same, right? Both are cash rich company, everything is same. Company A does not have any contingent liability. Company B have contingent liability, but company B have not disclosed contingent liability. Company B is having a contingent liability of 100 crores, but company B has not disclosed the contingent liability. So Srishti is indifferent whether she needs to invest in company A or company B, right? Why? Because all are same company, all are completely identical company, right? And both the company do not have contingent liability. A does not have contingent liability, B has not disclosed the contingent liability, and that's why Srishti is not aware about any contingent liability. Srishti, please tell me, or students, please tell me, if the contingent liability would have disclosed in B Limited, whether it will change the decision making capacity or whether it will influence the decision making capacity of Srishti, whether she will be in a position to take a prudent decision that yes, I should go for A because in B there could be some exposure in future, or probably if I have to go into B, I have to do more negotiations, right? I have to factor this potential liability as well. So guys, just give me a minute. Yes. So friends, the subjective definition of materiality is given in Ind AS 1 as well as in Ind AS Schedule 3. Any threshold is not given that what should be the material item, right? But Ind AS Schedule 3 says that if any item of income or expenditure which exceeds 1% of the revenue from operations, or rupees 10 lakh, whichever is higher. For example, the revenue from operation is 100 crores. Then what is the 1%? 1 crore. So if any item, for example, prepaid expenses, the company has not disclosed the prepaid expenses separately. But if the prepaid expenses is 1% is 1 crore, so 10 lakh or 1 crore, whichever is higher, 1 crore is higher. Okay. So anything which is beyond 1 crore in my example has to be disclosed separately in the notes to accounts, right? So this is given in Schedule 3, but the materiality is, the subjective definition of materiality is given in Schedule 3 and Ind AS 1. No threshold has been given. Okay. But Ind AS Schedule 3 says that any item in the financial statement which is exceeding 1% of the revenue or 10 lakh, whichever is higher, needs to be disclosed separately, right? So is it clear, friends? Point number 14 is clear. So threshold for materiality is not defined. The subjective definition of materiality is defined, right? Is it clear? Coming to the question number 15, any item of income or expenditure which exceeds 1% of the revenue or 10 lakh, whichever is higher, needs to be disclosed. Is this requirement pertains to Ind AS or Schedule 3? This requirement is not in Ind AS. This requirement pertains to Schedule 3. Division 2 to Schedule 3, right? Division 2 to Schedule 3. Is it clear? Is it clear, friends? I hope it is clear to all of you. Yeah. So Rahul, today the PPTs will get uploaded on the BOS portal, right? Clear? Is there any aging related disclosure given in Schedule 3? Yes. In Schedule 3, there was a huge amendment which came on 24th March 2021. And in those amendments, I will quickly discuss those amendments. In those amendments, you know, the trade receivable, trade payable, capital work in progress. So the aging of these items are required to be given, right? What were the major amendment in Schedule 3 in accordance with the last amendment dated 24th March 2021? I will discuss the major amendments in the major amendment which was happened on 24th March 2021. But before that, guys, let's have a 10 minutes break, right? And after the break, we will discuss some amendments and we will discuss the format of balance sheet, P&L and SOC. I will show you the format and we will discuss the amendments in Schedule 3, right? Is it clear to all of you? Good. Let's have a 10 minutes break. We will start at, it is 8:23 now, we'll start at 8:33. doubts if there is anything which is there. Yeah. So let's discuss the format of balance sheet P&L, and let me show you the formats, and then I'll come to the major amendments which was happened on 24th March 2021. So first, let me take you through the formats. Let me know if the formats are visible. I hope the study material is visible now. So this is the balance sheet format. This balance sheet format has been bifurcated into current and non-current assets. So into non-current assets, there are separate assets like property, plant and equipment, capital work in progress, investment property, goodwill, other intangible assets, intangible asset under development, biological assets, financial assets. So if I compare this division 2 balance sheet format with division 1, or I mean to say old IGAP format, AS format. So under our division 1 format, which was accounting standard format of balance sheet, it started with equity, then your non-current liability, then current liability, then non-current asset, then current asset. In division 2 to schedule 3 format, asset comes first, right? And likewise, old format under accounting standard, the assets and liability has to be bifurcated into non-current and current. The nomenclature and terminologies could be different. For example, if you see the G item, biological assets other than bearer plant. So this is a concept which is given under Indian accounting standard, because under Ind AS there is a separate standard, Ind AS 41, which talks about agriculture. So this is a concept which is given under agriculture standard, but no such guidance was given in the accounting standard, and hence the division 1 to schedule 3, I mean to say old format under AS, has not prescribed such presentation of such line item in the balance sheet. Okay. So what is this item? You will be able to understand when you will read Ind AS 41 agriculture standard. Then in Indian accounting standard, also there are 3 standards which takes care of financial instruments, financial asset, financial liability, right? Equity. So apart from bifurcation into current and non-current, your division 2 to schedule 3 also prescribes the bifurcation of item into financial and non-financial. Although the word non-financial has not been used, but these items from item number A to G, these are the non-financial item. But if any item is a financial item, it has to be disclosed separately. What is meant by financial item? Just for the layman understanding, any item or any asset when there is a contractual right to receive cash. For example, when you sell investment, I mean to say from investment you will get a cash. Trade receivables, you will get a cash. Loans, you will get a cash. You will realize or you will recover a cash. Okay. So these are the financial item, financial assets. So if any asset which is a financial asset, it has to be presented or disclosed separately, right? So this is one of the additional requirement in Ind AS Schedule 3. Deferred tax assets. As per Indian Accounting Standard 1, para 56, please write down. Para 56 of Ind AS 1. This deferred tax asset will always be classified as non-current asset, right? Always be classified as non-current asset. Other non-current asset, this is a residual category. Any asset which has not been specifically provided or presented in the above items, okay, has to be presented as other non-current assets. Coming to the current asset like inventory is a current asset. Then the financial assets are there, right? Then current tax assets net is there, then other current assets. Then in equity and liability, equity share capital, other equity. Other equity is nothing, it's a reserves and surplus. But the boundary of, or I would say the diameter or radius of other equity has been expanded or extended a lot. Okay. Coming to the liabilities. So non-current liabilities and current liabilities are there as far as liabilities are concerned. Again, liabilities has been bifurcated into financial liabilities and non-financial liabilities, although the word non-financial liabilities has been not been used, but it is understood if anything which is not bifurcated into financial, it is non-financial. Okay. In financial liabilities, borrowings are there, lease liabilities are there. So when you will read Ind AS 116, you will find that the lease accounting is totally different in Indian accounting standard and IFRS in comparison to accounting standard, right? Then trade payable has to be bifurcated into trade payable outstanding for MSMED and other than MSMED, right? Then provisions are there. Deferred tax liability will always be non-current and other non-current liabilities. In current liabilities, in financial liabilities, borrowings are there, lease liabilities is there, trade payable is there, right? And in this 24th March 2021, this lease liability have been inserted in the balance sheet format, right? Even companies prior to 24th March 2021, companies were also disclosing it separately, but it become part of Schedule 3 on 24 March 2021 as a separate disclosure, right? So this is the balance sheet format. What is the statement of changes in equity format? First one is equity share capital, and we need to provide the comparative for 1 year also. So what is my opening balance of equity share capital? What is the changes in equity share capital due to prior period error? If the company has presented wrong equity share capital, company has made a mistake, if there are some prior period error, then you need to disclose that, you need to present that prior period error impact as a separate impact. Okay. Then it is a restated opening balance after correction of error. Then what is the changes in equity share capital during the current year? For example, there is a right issue, okay, issue of share capital. There is a buyback of share capital. So you have to give those changes and it will give you the closing balance. Okay. So friends, while discussing these items under Ind AS Schedule 3, we are also covering the items under Ind AS 1 as well, right? As I told you, what are the component of the financial statement, that is as per Ind AS 1. As I told you the definition of materiality, any item, the omission, misstatement or obscuring will impact in the decision making capacity of the user of the financial statement will be considered as material, right? So these things will also be covered under Ind AS 1. Classification of current and non-current, this guidance is given under Ind AS 1 as well. The deferred tax assets and liability has to be classified as non-current, para 56 of Ind AS 1. This guidance is given under Ind AS 1, right? Likewise, for other equity, you have to give the reconciliation of share application money pending allotment, equity component of compound financial instrument. So friends, when you read financial instrument standard, you will found that there are compound financial instrument also. So the equity component will come here and the debt component will go into the liability side. Okay. Then under reserves and surplus, your capital reserve, security premium, or whatever other reserve will be there, it will come here, retained earning. Then these items are other comprehensive income items, right? So these items are required to be disclosed separately. Then if there is any money received against share capital, that is also required to be received separately. Okay. Yeah. So same disclosure should be given for the comparative period. Then coming to the statement of profit and loss. Yeah. When you see the statement of profit and loss, balance sheet is always as it, but statement of profit and loss is always for the period ended. Okay. So if you see, the first item is revenue from operations, right? And friends, in Ind AS 1, the format has not been given, but the minimum item to be presented on the face of the balance sheet is given. Minimum line item to be presented on the face of the P&L is also given. And let me ask you one more question here. Whatever format is given under Ind AS 1 or is given under Schedule 3 or is prescribed as per Ind AS 1, the items which are prescribed as per Ind AS 1. For example, if the company is not having other income in the current year as well as in the previous year, or the company is not having any biological asset, which was given as a separate line item to be presented on the face of the balance sheet as per Ind AS 1 and as per schedule 3. So for example, the company does not have any biological asset. Whether the company is required to be present at line item with numbers as a 00 or nil. If company does not have any amount in the current year or in the previous year in a line item, let's say biological asset. So do we need to present that line item as a nil amount, or we should not present that particular line item? What is your view? What is your view, guys? It is not required to be given. Okay. If there is no amount in the current year as well as comparative year, so it is not required to be disclosed separately, or it is not required to be presented separately. Okay. But if the amount is there in the current year or in the comparative year, even if in the 1 year the amount is there, it has to be disclosed separately. Okay. Clear? So revenue from operation is there, other income is there, total income is there, right? Then coming to the expenses. So cost of material consumed, purchases. So these all items, the same items which was there in the division 1 to the P&L. Okay, division 1 to the schedule 3. Employee benefit expenses, finance cost, depreciation and amortization, other expenses, total expenses, profit or loss before exceptional item. Then exceptional items are there. So friends, in our division 1 to schedule 3, in our old schedule 3, there were 2 items. You remember there were 3 items rather. Prior period item, extraordinary item, and exceptional item. In Ind AS schedule 3, the concept of prior period item is not there. The concept of extraordinary item is not there. The concept of exceptional item is there. And when we will discuss Ind AS 1, we will discuss why extraordinary item has not been disclosed separately, why prior period item has not been disclosed separately, but the concept of exceptional item is there, and that is why it is there in the division 2 to the P&L format. Right? Right? Then there is a tax expense. Then there is a profit or loss from the continuing operation. If there is any profit or loss from discontinuing operation, it has to be mentioned separately as per Ind AS 105. Right? The same disclosure was there in division 1 to the schedule 3 also. It will give you the profit or loss for the period. Then there is a other comprehensive income. I have told you this is a new concept under Ind AS or IFRS, right? Then there is a disclosure relating to other comprehensive income. In other comprehensive income, the other comprehensive income has to be bifurcated into 2 parts. Item that will not be reclassified to profit and loss. Item that will be reclassified to profit or loss. Which profit or loss it is talking about? It is talking about this profit or loss. It is talking about this profit or loss. Whether this item has to be shifted from other comprehensive income to upside or not, right? So it is talking about that. But what is this? We will discuss when we will discuss Ind AS 1 P&L. Okay, we will discuss that. But as far as the format is concerned, the other comprehensive income has to be bifurcated into 2 parts: item that will not be reclassified to P&L, item that will be reclassified to P&L. And tax impact of such item has to be disclosed separately. Okay, so profit after tax plus total comprehensive income, profit after tax plus other comprehensive income will known as a total comprehensive income. Then earning per share will be there, and earning per share for continuing operation, for discontinuing operation, and for total operation has to be disclosed separately, right? This is your P&L format. And friends, as far as P&L and balance sheet is concerned, for these items, the separate notes to accounts has also been given. Okay, for balance sheet items, for P&L item, the separate notes to accounts has been given. Now friends, let's discuss the important amendments in Ind AS schedule 3. Important amendments in Ind AS schedule 3, right? Let me know if you have any query. Let me know if you have any query so far. Srishti, we can remove items if the amount is not there in the current year as well as comparative year. Okay. The main header we cannot remove. For example, non-current asset, non-current liability, we cannot remove. Okay. But the items inside that we can remove. I hope it is clear to all of you. Yeah. I'll just wait for 30 seconds or 15 seconds and let me know if you have any query. Otherwise, I'll move forward. Yeah, good. So students, I'll discuss some important amendments in Schedule 3. Okay, the recent amendments in Schedule 3. So rounding off, we have discussed, and the recent amendment was 24th March 2021. And from which year these amendments were applicable? These amendments were applicable from the financial year 21-22. So if you are preparing a balance sheet for the year ending 22, March 22, or you are auditing a balance sheet for the year ending March 22, the amendments which were there in on 24 March 21 will be applicable. And these amendments will be applicable to current year as well as comparative year. Okay. So friends, the first amendment which I need to discuss is into equity share capital. Although friends, you have seen that there are a lot of disclosure into equity share capital. For example, issued, authorized share capital, issued and paid up capital. And you are also required to mention if there is a shareholding of more than 5%, then you have to provide what is the name of the shareholder, what is the percentage shareholding, how many share has been held by that particular shareholder. Okay. So relating to more than 5%, it was old disclosure. It was there in our old IGAP also, in old AS financial statement also. But on 24th March 2021, there was an amendment. And what was the amendment? That requirement has been expanded. And what is that requirement? It says that if the shares has been held by any promoter of the company, and the word promoter has been defined under Companies Act Section 2, subsection 69. For example, I am a promoter of the company and I am holding 0.01% share of the company, right? So earlier, this was not required to be disclosed, right? Earlier, the requirement for disclosure was a shareholder which is having 5% or more shares in the company, right? But now the amended requirement of Schedule 3 requires that if there is a promoter and promoter is a shareholder, then irrespective of the percentage, the name of the promoter, number of share he holds in a company, he or she or it holds in a company, what is the percentage of holding, and if there is any percentage change during the year, it is required to be disclosed, right? Let me show you the real life example of Hindustan Unilever Limited. Hindustan Unilever is a listed company, and how they have disclosed? They have disclosed in this manner. So these are the detail of shareholding by the promoter of the company. You can see these promoters are having a holding of less than 5%. Even this disclosure have been given. So this is the promoter holding as on 31st March 22, as on 31st March 21. This is the name of the promoter, per number of share, percentage holding, and in case of any percentage change in the year, since there is no change and hence it is nil. Okay. So this is how the companies are required to be disclosed. I hope you get a good insight after looking at this real life disclosure. Rahul is asking, sir, do we need to remember this format? So Rahul, you need to understand this format. Yes. Okay. So if you are practically doing or preparing the balance sheet, so you will be able to recall this format, right? So major heading you will be, you should remember. For example, non-current assets, then your PP, your CWIP, your intangible asset, investment property, biological asset, your financial assets. Okay. In financial asset, there is an investment, there is a cash and bank, trade receivables, there is a loans, then your deferred tax assets, then other non-current assets. So you need to remember these critical line items. Okay. Yes. So guys, I hope you're comfortable now after looking at this new disclosure. Any query so far? Shall I move forward? Good. Thanks, Rohan. Thanks, Radhika. Thanks, Sanjay. Okay. Let's move to the next one. Important one. Aging for trade payable. So, friends, earlier what happened? Earlier, for example, how people were manipulating their P&L, right? For example, if somebody needs to report less profit, or somebody needs to understate the profit, what they will say, they will call to their friend and they will say that please raise some invoices to me for some expenses, for booking some expenses. Okay. Or let's say I will book some provisions, for example consultancy expenses account debit to expenses payable account. Okay, I'll book some expenses in your name. Okay, and of course these are the bogus expenses. I would say that the services has never been taken and hence the payment will never has to be made, right? So friends, the government now wants to ask an aging of those trade payable also, right? And what will be the impact of that aging? Let me tell you. First of all, as far as trade payable is concerned, we were already disclosing the breakup of trade payable due to MSME and other than MSME. We were already disclosing. But now government has asked aging also, and what will be the benefit and what will be the impact of the aging? Let me tell you. So government has asked that you have to bifurcate the aging of trade payable into MSME and other than MSME. Okay. And once again, between the MSME and other than MSME, you have to bifurcate between disputed and other than disputed, disputed and non-disputed or undisputed. For example, if you have recorded an expense payable in your P&L or in your balance sheet in a particular year, and of course, since you are not required to pay that expenses, so let's say it is falling under the aging of more than 3 years or 1 to 2 years, then somebody will ask you that if it is an undisputed payment, you are paying everybody, you are a cash rich company, then why you are not paying these expenses? Why you are not paying to this party, right? Why it is not required to be paid? Show me the confirmation, show me the invoices. And if it is not required to be paid, then why you have not reversed these expenses? Okay, there could be a lot of questions by the auditor, by the regulators, by the government regarding these kind of payables, and hence the aging become very important while preparing the financial statement and while auditing the financial statement to ask a right set of questions. Okay, so friends, first of all, in aging, the disputed and undisputed has been given. If there are disputed trade payable and undisputed trade payable, it has to be disclosed separately. It has to be disclosed between MSME and non-MSME. And what is the aging? The aging is less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 year in total has to be given. Sir, if there are unbilled dues, I mean to say, sir, if there is accrued expenses which has not become due, where it has to be disclosed? You can disclose it as a separate line item as a accrued expenses. Like you can see the real life disclosure of TVS Motors. What they have done, they have shown MSME trade payable, other than MSME, then what is disputed MSME, what is disputed other than MSME, right? So then not due. For example, you have received the services or you have received the goods and the payment period is 60 days. So your payment will due after 60 days. So this creditor is not yet due. So you have to show a separate column for not yet due. Okay. Then if it is due but less than 1 year, 1 to 2 year, 2 to 3 year and more than 3 year, this total should tally with the balance sheet. And if there are accrued expenses, then it has to be shown separately. And there is no aging for accrued expenses. So it has to be shown separately. Okay. So generally it is accrued but not due. Okay. Is it clear? The invoices has not been received. So this is how the disclosure has to be made for trade payable. I hope it is clear to all of you. So Manav is asking, sir, whether shareholder holding more than 5% required to be shown after amendment? Yes, Manav. So Manav, even this more than 5% was always a requirement for disclosure. Okay. It was always a requirement. The new requirement was, even if it is a promoter shareholder, even the promoter holding is less than 5%, still you are required to disclose. Okay. And you can see this disclosure of Hindustan Unilever. What they have done, they have shown even this is 47.4%. So the entire promoter shareholding they have shown in a one disclosure. So it has to be disclosed, right? But in the other disclosure where you need to disclose more than 5% shareholder, there this Unilever PLC will also come. So one disclosure is promoter shareholding. The other disclosure is detail of shareholder holding more than 5% of share capital. In that disclosure, which is an old disclosure, this promoted shareholder will not come, only this will come in the another disclosure. Okay. But in the promoter disclosure, all the promoter who are the shareholder will come here. Okay. So guys, I hope this aging related trade payable aspect has also been clear. Sneha is asking, sir, do we need to show aging on the face of the balance sheet itself? Sneha, the aging cannot be shown on the face of the balance sheet. On the face of balance sheet, the trade payable is only bifurcated into MSME and other than MSME as per Schedule 3 requirement. So you have to strictly follow Schedule 3 format, right? This aging has to be disclosed in the notes to accounts, right? Now coming to the aging for trade receivables. So once again, coming to the trade receivable. So friends, as far as trade receivable is concerned, the government is asking you, MCA is asking you that you have to bifurcate your trade receivable into undisputed considered good, undisputed considered doubtful. Okay. So undisputed considered good, undisputed considered doubtful, disputed but considered good, disputed but considered doubtful. Okay. So you have to disclose these kind of, you have to bifurcate these kind of disclosures in for the trade receivables. So for the trade receivable, first of all, you have to bifurcate into 4 categories. Aging for disputed and undisputed trade receivable into 4 categories: considered good, considered doubtful, significant increase in credit risk, and credit impaired. So guys, first of all, considered good, considered doubtful, significant increase in credit risk, and credit impaired, right? And what is the aging? The aging is you have to disclose in less than 6 months, 6 months to 1 year, 1 to 2 year, 2 to 3 year, more than 3 year. The aging has to be calculated from the date outstanding for following period from the due date of payment. For example, I have raised an invoice to my customer on 1st January 2022. I am preparing my balance sheet on 31st March 2022. And there is a credit period of 90 days, right? There is a credit period of 90 days. So let's take this as a 2021, not 21-22. And this is 31st March 22, right? I'm preparing a balance sheet and I have not received any money from this debtor. So friends, what is the due date of payment in this case? The due date of payment, the payment was due on 1st April 2021, right? Because the invoice have been raised on 1st January 22, the credit period was 90 days. So it become due on 1st April 2021. So it will come under 6 months to 1 year, right? It will not come under 1 to 2 year. In the aging, it will come to the 6 months to 1 year. So the aging needs to be calculated from the due date of payment. Okay. From the due date of payment. Okay. So friend, how to disclose? I have shown here the real life disclosure of Tata Steel Limited. You can see that undisputed considered good, undisputed credit impaired. What is meant by credit impaired? For example, you have raised an invoice to the customer and the customer goes bankrupt. The customer has filed the insolvency petition. The customer went to NCLT. So it means the credit is impaired. The impairment should be there. What is meant by significant increase in credit risk? So you have to show into 4 categories, right? Considered good, right? Considered good, secured, unsecured. considered doubtful, significant increase in credit risk, and credit impaired, right? So for example, the credit worthiness of your customer is getting deteriorated. The credit rating has gone down. So in this case, it is an example of significant increase in credit risk, right? What is the example of considered good? Your customer is regularly paying the payments, so it is considered good. What is example of considered doubtful? For example, the customer is not paying you in time, right? And the customer has started delaying the payments, so it is one of the example of considered doubtful. Okay, so friends, these are the categories where you need to show your trade receivables disclosure, and the aging is not due. For example, in my example, in if you will prepare the aging on 31st March 2021 and the credit period is 90 days, so on 31st March 21 it was not due, it was due on 1st April. Okay, so not due, less than 6 months, 6 months to 1 year, 1 to 2 year, 2 to 3 year, more than 3 year, this is total. And the provision for bad debt has to be shown separately. Clear? I hope it is clear to all of you. Disclosure with respect to immovable properties whose title deeds are not held in the name of the company. So friends, as far as aging is concerned, I have shown you the aging of trade payable, trade receivable, and let's move to the next aging of CWIP, then we will come to this particular thing. Aging of capital work in progress is also required to be disclosed, so that being an auditor or being a regulator or a government, you can ask the right set of questions. You must have seen that the companies have started the projects like real estate projects, other projects, but either the projects are getting delayed or the projects are getting suspended. Now government is asking, if there is a CWIP, then you have to show CWIP into two parts. One is project in progress and project temporarily suspended. Now friends, tell me one thing. If the project is temporarily suspended, then being an auditor or being a regulator, will you not ask to the management that if the project is temporarily suspended, then whether you need to impair this capital work in progress, whether you need to book an impairment loss for this asset? Yeah, because it is an indicator of impairment. So you have to analyze that also, right? So you need to bifurcate into project which is live and project which is temporarily suspended. And what is the aging? You need to give the aging of less than 1 year, 1 to 2 year, 2 to 3 year, and more than 3 year. That this project is getting executed or getting started. The aging is more than 3 year, 2 to 3 year, 1 to 2 year, less than 1 year. You have to give the disclosure of this aging, right? And if in case the completion is overdue, the time has been extended or the cost has been extended. For example, everyone has a budget. For example, if somebody is constructing a factory, somebody is constructing a society, a real estate project, the budget was 200 crores. And if the budget was exceeded from the original plan, that is also required to be disclosed with the aging, right? If the time has been exceeded, again, it is also required to be disclosed. And let me show you, friends, with the help of the real life example of Hindustan Unilever. Aging of CWIP as on 31st March 22. Project in progress, project temporarily suspended. Aging is less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 year. Project temporarily suspended. This is the aging, right? So friends, for trade payable and CWIP, the aging is common. Less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 year. For trade receivable, the aging is not common. The aging is less than 6 months, 6 months to 1 year, right? Then 1 to 2 year, 2 to 3 year, more than 3 year. Right? The second disclosure is project where the timeline is exceeded, project where the budget is exceeded. So there is a 473 crores amount where the project timeline is exceeded. There are 2 crore amount where the budget is exceeded, right? And you can see that here, the aging is also given. Project at Kolkata factory, Assam factory, Kandla factory, Rajamundra factory, Khamagaon factory, and in temporarily suspended Gandhidham factory, right? So this is a breakup of live and suspended. And this breakup is given for projects where the time has exceeded. And this is the timeline. Okay, this is the timeline. Understood? Clear? Okay. And this is the detail of CWIP for the last year, 31st March 21, where again the timeline has been exceeded. Is it clear, guys? Is it clear? Let's move to the immovable property disclosure. Yeah. So let me see if there is any query, then I'll move to the next disclosure. Rahul is asking, sir, provision for audit fees comes under trade payable or under short-term provision? Rahul, first of all, audit fee is not a provision. It is kind of a accrued expenses. Okay. So provision for audit fee will come under trade payable, right? Then Sweta is asking, sir, please repeat the example of receivable, Sweta. In case of receivable, the aging has to be given from the due date of payment. For example, if the company is giving a credit period to the customer, then the due date of payment will start after completion of the credit period. And the aging is up to 6 months. I mean to say less than, first of all, not due, then less than 6 months. So it has to be seen from the due date of payment. So if something which is within the due date of payment, it is not due. Okay. And after due date of payment, you have to see what is less than 6 months, what is 6 months to 1 year, what is 1 to 2 year, what is 2 to 3 year, and what is more than 3 years, right? So, and again, this aging has to be disclosed. This aging of trade receivable, I mean to say the trade receivable has to be disclosed into 4 buckets, right? And what are those 4 buckets? What are those 4 buckets, Sweta? Can you tell me what are these 4 buckets which I have told you? Anyone who wants to tell me what is these 4 buckets? Yeah. Anyone? First of all, it has to be bifurcated into disputed and undisputed, first of all, right? And other than disputed and undisputed, it has to be bifurcated into which buckets, guys? Okay. So disputed or undisputed considered good. Okay, very good. What about others? Significant changes in credit risk. Okay. Understood. Then after significant increase in credit risk. So guys, first of all, trade receivable has to be bifurcated into considered, into disputed and undisputed, right? So it has, then it has to be bifurcated into considered good, significant increase in credit risk, and trade and credit impaired, right? So disputed and undisputed. In disputed and undisputed, it has to be bifurcated into 3 categories, not 4, 3 categories. Considered good, significant increase in credit risk. So considered doubtful will come under significant increase in credit risk or credit impaired. Considered good when the debtor is paying on time, healthy debtor. Significant increase in credit risk, the credit rating is getting downgraded. The credit rating is deteriorated. The debtor has started delaying the payments. Credit impaired, the credit worthiness has been badly impacted. It become bankrupt, insolvent, filed the insolvency petition. So it is the example of credit impaired. I hope I have answered your query, Shweta. Mohammad Ishan is saying, sir, aging will be done for all financial instrument item only or for trade receivable or trade payable? So Ishan, as per the requirement of Schedule 3, the aging has to be given only for trade receivable or trade payable and CWIP, okay? Not for all financial instrument. Although CWIP is not a financial instrument, but CWIP aging is also required. But as far as financial instrument is given, as per Division 2 to Schedule 3, only trade payable and trade receivable aging is required to be given. Sumit is asking, what is the meaning of project? So generally in the normal parlance, project means a construction activities, right? If you're constructing some asset, some big assets, constructing some societies, you are constructing some factories, right? So infra kind of projects or constructing big PP or big machineries could become under projects, right? Like in my Hindustan Unilever example, you can see that they have given an example of factories, right? Manav is asking, sir, example of significant credit risk, significant changes in credit risk. and credit impaired trade receivable. So Manav, I have already given an example. If the credit rating has been downgraded for a customer, or the customer has started delaying the payment, okay, the financial position of the customer is getting deteriorated. It is an example of significant changes in credit risk, right? Coming to the credit impaired, for example, the customer has already become bankrupt, insolvent, or the customer has filed the insolvency petition. Okay, the customer does not have money to pay your dues. The customer has already prepared their accounts not on a going concern basis. It is an example of credit impaired, right? So I have taken all the queries. So now let's go to the immovable property disclosure. Okay. So friends, immovable properties like land and building, right? Investment property. So sometimes what happens, the properties are in the name of the director or in the name of the KMP, and it has to be shown in, and the companies are disclosing or presenting that property in the name of the company in the balance sheet of the company. So now the revised or amended requirement says that in case of immovable property, first you have to disclose the immovable property where the title deeds are not in the name of the company. So this disclosure is only for those immovable properties where the title deed is not in the name of the company. First, you need to disclose what is the relevant item in the balance sheet. For example, if the land and building is used in the business operation, it is covered under PPE, property, plant and equipment, as per Ind AS 16. If the land and building is used for earning rentals or held for capital appreciation, it is investment property as per Ind AS 40, right? Or if the land and building is held for sale, the company is not using that land and building, and the land and building has been classified as held for sale, then it has to be shown as a separate line item in the balance sheet. So you have to disclose what is the relevant line item in the balance sheet. You have to disclose the description of item of property. Then you have to disclose what is the gross value. Then you have to disclose title deed is held in the name of whom. It is in the name of the company or it is not in the name of the company. So this disclosure is required if it is not in the name of the company. Okay. So title deed held in the name of whom, it is required to be disclosed. Whether title deed holder is a promoter, director, or a relative of promoter, director, or employee of promoter or director, it is also required to be disclosed. And this property held since which date is also required to be disclosed. Reason for not being held in the name of the company, why it is not in the name of the company, this is also required to be disclosed. Let's discuss with a real life example. If you will see the disclosure in Tata Steel Limited, you can see the first one is description of property. Freehold land, buildings, freehold land, buildings. Although they have not disclosed whether it is PP or investment property, right? It should have been disclosed whether it is come under PP or investment property, right? Then what is the gross carrying value, right? So gross carrying value, this is current year, this is previous year. Held in the name of the company, not applicable. Held in the name of the company, erstwhile Tata Steel BSL Limited, Bhushan Steel Limited, Bhushan Steel Limited, Tata SSL Limited. Okay, so they have given held in the name of whom? Whether promoter, director, or the relative or employee? Answer is no. Property held, period held, from which date? So they have given the dates also. Reason for not being held in the name of the company, the title deeds are not available with the company. Guys, you can see that this property they are holding since March 1928, before independence. This they are holding since 1960, right? So probably these are very old properties. They don't have the title deeds. Okay, but their factory has been constructed, their assets were there, they were using that property, no one has disputed that property, right? So hence they have disclosed this fact in the notes to accounts as per the revised requirement. And coming to this, Tata Steel has acquired Bhushan Steel and they have done other acquisition also. And as a part of merger and acquisitions, the properties of Bhushan Steel will become the property of Tata Steel, right? They have given this fact also for certain properties acquired through amalgamation or merger, the name change in the name of the company is pending. Okay, so they have given this disclosure also. So guys, these are the important disclosure in the as per the revised requirement of Ind AS. Schedule 3. And guys, one more disclosure, important disclosure is your ratios. Earlier, the ratios were not required to be disclosed in the financial statement. The requirement for disclosure of ratio was there in SEBI LODR requirement, right? Or in the annual report. But now the regulators wants to judge the financial position of the company, the solvency. They want to look at the profitability ratio, solvency ratio, current ratio. Okay. So they want to look at these ratios of the company, data turnover ratios. They want to look at these ratios of the company. Okay. And hence the 11 ratios has been given, 11 ratios have been given for as per the revised requirement of Ind AS amended Schedule 3. Current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, net capital turnover ratio, net profit ratio, return on capital employed, return on investment, right? Sir, whether the formula, what is my numerator and what is my denominator, whether this formula is given under the Ind AS Schedule 3, answer is no. The formula is given in the guidance note to the division to the Schedule 3 issued by ICAI. The formula is given there. The formula is not given in your Schedule 3. The formula is given in the guidance note of ICAI. Okay, guidance note to Schedule 3. Right? Is it clear, friends? Is it clear? The formula is not given in the Schedule 3. The formula is given in the guidance note. Okay, this is for your reference. So, friends, what is required to be disclosed? I'll show you with the real life example of Infosys Limited. So first of all, the ratios are required to be disclosed and formula is also required to be disclosed. What is numerator? What is denominator? Then what is the ratio in the current year? What is the ratio in the last year? And what is the variance? And if the variance is plus minus more than 25%, then the reason for more than 25% variation is also required to be disclosed. For example, there was a variation of 35.1% in net capital turnover ratio. In the last year, it was 2.8. In current year, it is 3.8. So the variation is 35.1%. It is more than 25%. So the company has given the reason. The reason for variance is revenue growth along with higher efficiency on working capital improvement has resulted in an improvement in the ratio. Right? So these kind of disclosures is required under Division 2 to Schedule 3. So friends, from the real life perspective, this Division 2 to Schedule 3 is very important. I would request if you guys are into articleship and in your firm, if you guys have a Ind AS assignment, please try to work on that Ind AS assignment. At least please try to work on the presentation of financial statement part. If you guys are not working anywhere or you guys are not having any Ind AS assignment in your firm where you are doing your articleship, I would request please refer one annual report. Please download one annual report and look at the disclosures. Look at the formats. Look at the disclosure of the Ind AS financial statement. Right? You can download Hindustan Unilever Limited. You can download Infosys Limited. So you can download any report. But I would recommend please download Tata Steel Limited or Hindustan Unilever Limited. Okay. So friends, with this, we have covered Ind AS Schedule 3. We have covered Ind AS Schedule 3. Right? With the help of these 16 or 17 questions, I have shown you the format of balance sheet, P&L and SOCI also. I have shown you the real life examples, the real life format also. I have shown you the important amendment in Schedule 3, Division 2 to Schedule 3, like promoter shareholding requirement, trade payable aging, trade receivable aging, CWIP aging, then your ratios, then your immovable property disclosure where title deed is not held in the name of the company. We have discussed the requirement of rounding off in the financial statement. Okay, so we have discussed these aspects in as per the amendment requirement, as per the amended requirement, wide notification dated 24th March 2021. So this is only required from your examination perspective or from your understanding perspective for the examination as a CA final student. Right? I hope you guys are comfortable so far. If you guys have any questions, please let me know. And after that, I'll start Ind AS 1. although I have already started Ind AS 1 and some concept I have already covered while discussing these concepts. So guys, please let me know. Yes, Roshan, you will get the notes as well. Sneha, I hope it is visible now. Friends, please let me know if you have any questions. Yeah, thank you, Srishti. Yeah, is it clear to everyone? So these 17 questions are very, very, very important questions. I would say these 17 questions are the entire universe on understanding of division 2 to schedule 3, right? For you, division 2 to schedule 3 is important and is applicable. Clear? Okay. Yes, great. Now I am starting Ind AS 1. I hope my Ind AS 1 PPT is visible. So let me share Ind AS 1 PPT. Yeah, friends. So friends, Ind AS 1 talks about presentation of financial statement. So whenever you have to prepare the financial statement, two things are very important. One, division 2 to schedule 3, division 2 to schedule 3, and the second one is Ind AS 1. I would say in our old scenario, when I'm talking about old scenario, I mean to say in accounting standard scenario, this accounting standard were not much relevant from the presentation of financial statement perspective. But Ind AS 1 is very important from the perspective of presentation of financial statement. What was the counterpart standard in AS? In AS, it was AS 1. And if you're able to remember the title of AS 1, what was the name of the AS 1? What was the title of the AS 1? Guys, what was the title of AS 1? What was the title of the AS 1? Yes, you're right, Rohan. The title was Disclosure of Accounting Policies. And what is the title of Ind AS 1? The title of Ind AS 1 is Presentation of Financial Statement. So which is the bigger word? Presentation of financial statement is a bigger thing, or disclosure of accounting policies is a bigger thing? Of course, presentation of financial statement. Financial statement includes your accounting policy. Financial statement includes your balance sheet, your P&L, your statement of cash flows, your statement of changes in equity, your notes to accounts, and accounting policies are one of the component, one of the element of notes to accounts. It is one of the area of notes to accounts. Is it clear to everyone? Yeah. Is it clear to everyone? So Manini is asking, sir, from where we can get the recent amendments? Manini, the study material of ICAI is updated material. Okay. So the amendments are already there. I will also share my PPT, and that PPT which I have shown you, this PPT is also having the amended requirement as well as the real life examples. I will also share my PPT as well. But the ICI study material is already having this updated division 2 to schedule 3. Okay. Yeah. Muhammad Ishan is asking, sir, net worth will be taken on the basis of standalone financial statement or consolidated financial statement. So Ishan, I have told yesterday also, the net worth has to be seen from the perspective of standalone financial statement. Net worth is not required to be seen from consolidated financial statement, right? Is it clear? Good. Yes. So friends, two things are relevant for presentation of financial statement: division 2 to schedule 3 and Ind AS 1, right? So why Ind AS 1? This is such a kind of standard which gives you that which tells you what is current, what is non-current. It says that the entire balance sheet item has to be bifurcated into current and non-current. It tells you that what is the structure of the balance sheet, what are the minimum line item on the face of the balance sheet which is required. It tells you what is the structure of statement of profit and loss, what are the minimum line item which is required in the statement of profit and loss, what is the structure of statement of changes in equity, right? How this cash flow statement has to be prepared. Although the format or the guidance has not been prescribed in Ind AS 1, for statement of cash flow, Ind AS 1 only says that you have to refer Ind AS 7 for the preparation of Ind AS, for the preparation of statement of cash flows, for the preparation of statement of cash flows. Okay, you have to refer that. Is it clear? Is it clear, guys? I hope it is clear to all of you. Yeah. Notes to accounts. This Ind AS 1 also provides a guidance that what should be the sequence of the notes to accounts, what all needs to be covered in the notes to accounts. Very high level view has been given in the Ind AS 1 regarding notes to accounts, right? So we'll talk this all things one by one. Ind AS 1 also covers the structure of the financial statement, the features of the financial statement. Even we all know that the financial statement needs to be prepared on an accrual basis, but this fact is written in Ind AS 1 also. We all are aware that the financial statement has to be prepared on a going concern basis. You remember, this was the fundamental accounting assumption in Accounting Standard 1, right? So this is written in Ind AS 1 that the financial statement needs to be prepared on a going concern basis. And if it is not prepared on a going concern basis, then some sort of disclosures are required to be made, right? So guys, we all are aware, even as per division 2 to schedule 3, there is a comparative which needs to be given. At least 1 year comparative needs to be given. And this is written in Ind AS 1 as well. So Ind AS 1 is a very important standard. If you want to have a comfort on the preparation of the financial statement, you have to be well versed with Ind AS 1 in addition to division 2 to schedule 3, right? You have to refer the line items which is given in the balance sheet format, P&L format, SOC format, right, in Ind AS 1. Is it clear, friends? So theoretical part, objective and scope, we will discuss. Purpose of financial statement, we will discuss. Component of financial statement. What are the component of the financial statement, guys? What are the component of the financial statement? What are the component of the financial statement? Yes, balance sheet, P&L, statement of changes in equity, statement of cash flows, and notes to accounts. Okay. Definition. Some definitions are there. We will discuss. And overall consideration. What will be the general features? Structure and content relating to the component. Right. Overall consideration relating to the financial statement. We are going to discuss all these aspects here. What is the objective of Ind AS 1? Objective of Ind AS 1 is to prescribe the basis for presentation. See, the word is presentation of general purpose financial statement. The word is general purpose financial statement, right? What is meant by general purpose financial statement? What is meant by general purpose financial statement? General purpose financial statement are those financial statement which is available for public at large, which is available for the user of the financial statement. For example, Mr. Ambani asked his CFO that, Mr. CFO, show me a balance sheet which will start with your debtors. Okay. And what you will do, you will classify the debtor into two parts on the face of the balance sheet. One is domestic debtors and overseas debtors. Okay. Then you need to show me the property, plant and equipment. And in property, plant and equipment, you have to bifurcate into two parts. PP relating to Jamnagar refinery plant, other than Jamnagar refinery plant, other than that, right? So guys, the way Mr. Ambani is asking the balance sheet to be prepared by CFO, can I call it as a general purpose financial statement? If I as a shareholder will ask such balance sheet to the CFO of Reliance, whether he will provide me such balance sheet, although he will provide that balance sheet to Mr. Ambani, but if I will ask as a shareholder or as a regulator whether he will provide me such balance sheet, he will not provide me such balance sheet. Why? Because that Balance sheet is not a general purpose financial statement. That is a special purpose or tailor made or MIS, like MIS related financial statement. Okay. So general purpose financial statement are those financial statements which have been prepared as per the relevant generally accepted accounting principles, which includes your Companies Act regulations and Indian accounting standards, right? So general purpose financial statement are those financial statements which have been prepared as per Division 2 to Schedule 3 and in accordance with Indian accounting standards, right? Is it clear? Is it clear? Yeah. So to ensure comparability, and this standard also ensure comparability with entities' own financial statement of previous period. This provide the structure guidance. This provide the features guidance. This provides that the comparative needs to be given and there is a consistency in the presentation. So this standard also ensure the comparability of one entity financial statement with the other entity financial statement and comparability of within entities financial statement from one period to another, right? And this standard also set the overall requirement of the presentation of financial statement, guideline for the structure, and minimum requirement for the content. Okay. Coming to the scope, this standard is applicable in preparing and presenting general purpose financial statement only. The financial statement asked by Mr. Ambani is not prepared in accordance with Ind AS 1. On that specific purpose financial statement or special purpose financial statement, this Ind AS 1 will not be applicable. Okay. Other Ind AS set out the recognition, measurement, and disclosure requirement for a specific transaction and other events. For specific transaction and other events. Okay. So, friends, other Ind AS, for example, property, plant, and equipment. So, when an item has to be recognized as PPE, when an intangible asset has to be recognized, how deferred tax has to be measured and calculated. So these kind of specific requirement, related party disclosure, these kind of requirement is not given in Ind AS 1. So these kind of recognition, measurement, and disclosure requirement for specific transaction and events is given in the other Ind AS, right? So apart from Ind AS 1, there are 38 other Ind AS. Understood? It is not applied to structure and content of condensed interim financial statement under Ind AS 34. So friends, you are aware that the listed companies are preparing interim financial statement. So this standard is not applicable to interim financial statement as far as structure and content is concerned because they are preparing condensed financial statement. But as far as general features are concerned, for interim financial statement, this standard will be applicable as far as general features are concerned. For example, going concern. For example, going concern. Of course, doesn't matter if you are preparing interim financial statement or final financial statement. Doesn't matter if you are preparing an interim financial statement or annual financial statement. You have to prepare the financial statement on a going concern basis. You have to prepare the financial statement on accrual basis, right? So this is there. Okay. So for structure and content, it is not applicable. Why? Because interim financial statement can be prepared as a condensed financial statement. Limited disclosures are there. Whether Ind AS 1 applies to consolidated financial statement also, answer is yes. It applies equally to all entities, including those that present CFS. Okay. Like Division 2 to Schedule 3 is also applicable to CFS. Ind AS 1 is also applicable to CFS. Sir, whether Ind AS 1 will tell us how to do the consolidation, answer is no. Ind AS 110 will tell you how to do the consolidation. Ind AS 1 presentation of financial statement requirement will be applicable to consolidated financial statement as well. Okay. Guys, are you enjoying the session? Are you able to understand it? Yeah. Please let me know. Manini, Ishan, Roshan, Sumit, Srividya, Srishti, Sneha, Shweta, Rahul, Rohan, Shweta, yeah, Srishti, Girish. Great, guys. Great. Okay. Yes, Sumit, you're right. Great, friends. Thank you so much. Yeah. So general purpose financial statement we have discussed. That general purpose financial statement are those financial statements which have been prepared as per the applicable GAAP, generally accepted accounting principles, right? Which have been prepared as per the requirement of Companies Act as well as Ind AS Schedule 3 and Indian accounting standards. What are Ind AS? Indian accounting standard, a converged version of IFRS applicable to India, which is prescribed under section 133 of Companies Act. Guys, AS and Ind AS both are prescribed under Ind AS. Both are prescribed under section 133 of Companies Act 2013. Section 133 of Companies Act 2013, right? Accounting standards are prescribed under Companies AS rules 2021. Ind AS are prescribed under Companies Ind AS rules 2015. Okay. So AS and Ind AS both are notified under section 133 of Companies Act 2013. But AS are notified under Companies AS rules 2021. Ind AS are notified under Companies Ind AS rules 2015. Right. Is it clear? Is it clear, guys? So what is meant by material? Material means, what is meant by materiality, or what is meant by material? So material, you remember I have explained this word. Any information will be considered as material if the omission means hiding the information. Misstating means stating the wrong information, or obscuring means scattering the information, right? For example, somebody got fail in the examination. So how he will say this fact to his parents? First of all, he will say that Papa, the exam was really tough. The paper was really tough. Okay. Or for example, the paper didn't went well. So first of all, he will create all the background, right? So that the impact in the mind of the Papa will not be a huge impact, right? So first of all, he will tell his father that Papa, the exam was really tough. Okay, it was really tough. The paper was out of syllabus. Okay. Then after some time, he will tell that even no one was able to complete the paper in time. The invigilator or the school, our class teacher or the teacher was already saying that yes, paper was really very tough this time, right? And no one was able to complete in time, and a lot of people have left in between, right? So you've set all the backgrounds, right? And then you have said that yes, I have also not completed the entire paper, and there are very less chances that I will be able to crack this paper or crack this exam. So guys, what you have done, instead of giving the material information at a one place, you have scattered the information, right? So that it will not influence the user of the financial statement while taking the decision, right? It will not influence the user of the financial statement while taking the decision. So for an important information, you have scattered that information into different places as a small piece of information. So this is known as a obscuring, or you have presented information in such a manner, in such a complex manner, that no one will able to understand that what you have provided, right? So any information will be considered as a material if any omission, misstatement, or obscuring will result into influencing the decision making capacity of the user of the financial statement on the basis of those financial statement, right? And guys, materiality will vary from one entity to another entity. For example, Reliance Industries is having a turnover in lakhs of crores. They have a profitability of 40,000 crores, 50,000 crores. The accountant has forgot to record an expense of 2 crore in the P&L for a year. The accountant has forgot to record, and they are rounding off into the crores. So do you think that this 2 crore non-recording of expenses is a material expense for Reliance? Do you think if somebody will tell you that the profitability is 35,000 crores or 40,000 crores, somebody will tell you it should have been not 40,000 crore, it should have been 40,002 crores. So whether your decision to buy Reliance shares or not to buy Reliance shares will be impacted by this 2 crores. Yeah, whether it will be impacted. Yeah, it will not be impacted. How does it matter? Even the earning per share will not change in decimals, right? So it's just like a peanut for Reliance. It's a penny for Reliance, right? They are rounding off into the crores. Okay. So this is not a material item. So what is material? You need to assess, you need to judge, you need to evaluate, right? Material item are those items which are which can impact the decision making capacity of the user of the financial statement. So guys, yes, 2-3 participants or students are saying it is more beneficial to put the important information as a notes in our notebook. Yes, of course. So being a student or being a listener, you have to note down the important information in your notes in your notebook, right? In your notebook. And guys, the best use, or I would say these live classes are so useful. If you skip something in between to write down, you can refer the classes on YouTube also for updating your notes in your notebook, right? Am I right? Great. So coming to the purpose of the financial statement. So your balance sheet shows the financial position, right? Your balance sheet shows the financial position. Your P&L, your statement of changes in equity shows the financial performance. Your cash flow shows the liquid statement of financial position. Your statement of cash flow shows the liquidity position. Statement of cash flows shows the liquidity position, cash flow position, right? So balance sheet shows the financial position, P&L shows the financial performance position, and your statement of cash flow shows the cash flow position, right? Clear? Components or complete set of financial statement. We have discussed that balance sheet. We have discussed the statement of profit and loss is there. And here there is a new concept of other comprehensive income, including OCI. Then statement of changes in equity is there. What is statement of changes in equity? It is nothing. It's a reconciliation. It's a reconciliation or movement of capital and reserves. Cash flow statement. It's again a same statement, right? Cash flow statement has to be prepared in accordance with Indian Accounting Standards 7. Schedule 3 does not prescribe. Division 2 to Schedule 3 does not prescribe any format of cash flow statement, right? It is prescribed by Ind AS 7. Notes to accounts. So notes to accounts includes your accounting policies as well as explanatory notes, right? What could be the explanatory notes? The breakup of balance sheet items like PP schedule, intangible schedule, loan schedule, investment schedules, right? So the breakup of balance sheet and P&L items and the specific disclosure required by specific Ind AS. For example, Ind AS 108 segment reporting requires a segment related disclosure. Ind AS 24 related party disclosure requires a related party disclosure. Ind AS 19 employee benefit standard requires actuarial disclosures, right? Ind AS 37 provisions contingent liability and contingent asset standard requires the disclosures around contingent liabilities, right? Comparative information has to be given for at least 1 year, right? And there is again a new requirement. What is that new requirement? A balance sheet as at the beginning of the earliest comparative period is required to be disclosed. A balance sheet as at the beginning of the earliest comparative period is required to be disclosed when an entity applies an accounting policy retrospectively. When an entity applies an accounting policy retrospectively, or when an entity makes a retrospective restatement of item in the financial statement, or when it reclassifies item in its financial statement. Sir, what does it mean? So guys, Ind AS 1 is talking about a balance sheet. It has to be provided, it has to be given as at the beginning of the earliest comparative period. So friends, for example, for financial year 21-22, what is the balance sheet? Balance sheet as at 31st March 22 needs to be prepared. What is the comparative for this year? The comparative is 31st March 2021. Okay. So a balance sheet as at beginning of the earliest comparative period. What is my earliest comparative period in this case? Friends, in this case, what is my earliest comparative period? What is the earliest comparative period in this case? Yes, 2021. Financial year 2021 is the earliest comparative period. 31st March 21 balance sheet is required to be given. Yes. So 2021 is the earliest comparative period. Clear? Clear? So a balance sheet as a beginning. So what is the opening? What is the opening date of earliest comparative period? Opening date. I'm talking about the opening date. What is the opening date of earliest comparative period? What is the opening date of earliest comparative period? Very good. The opening date of earliest comparative period is 1st April 2020. Yes. So opening, closing is 31st March, opening is 1st April, right? Right? Is it clear? Is it clear, friends? 1st April 2020, not 21, Ishan, 2020. Your 2021 is the last year, 2020, 21 is the last year, right? So this financial year is 2021. Okay. So what is the opening? What is a balance sheet as at the beginning of the earliest comparative period? So it is 1st April 2020. It is 1st April 2020, right? So friends, this item talks about the third balance sheet. And what is the third balance sheet? When is this third balance sheet will be required? This third balance sheet will be required largely when there is a change in the accounting policy of the company, or when there is a prior period error, when there is a prior period error in the company, when there is a prior period error, or when there is a change in accounting policy of the company. Let's understand this concept with the help of this case study. Please let me know if my Excel file is visible to all of you. Please let me know if this Excel file is visible. So this is the case study on third balance sheet. And friends, this concept is given in Ind AS 1 as well as Ind AS 8. When you will read Ind AS 8, which talks about accounting policies, accounting estimates, and correction of errors, you will find the same concept in Ind AS 8 also, right? So case study on third balance sheet. A Limited purchased a machine. A Limited purchased a machine for rupees 1 lakh on 1st April 2016, having a useful life of 10 years, right? So what was the cost of the machine? 1 lakh rupees. What is the date of purchase? 1st April 16. So actual cost of machine is 1 lakh. Date of purchase is 1st April 16, and useful life is 10 years. Okay. Useful life is 10 years. The accountant has wrongly passed an entry for rupees 10,000 instead of rupees 1 lakh. So friends, instead of 1 lakh rupees, the accountant has wrongly passed an entry of 10,000 rupees. So what was the impact of this entry? So cost was wrongly booked. It should have been 1 lakh. but it was wrongly booked as 10,000. So what happened in this case? In this case, the machine was understated. The accounting entry should have been machine account debit to cash account by 1 lakh rupees, but this entry has been made machine account debit to cash. It should have been done by 1 lakh rupees, but it has been done by 10,000 rupees, right? So it means cash was overstated and machine was understated, right? And since it was an offsetting error, it was a compensating error, and hence the balance sheet got tallied, right? Is it right? Yeah. Now, friends, what was the impact of this error, right? So let's discuss this question again. A Limited purchased a machine for rupees 1 lakh on 1st April 2016, having a useful life of 10 years. The accountant has wrongly passed an entry for rupees 10,000 instead of rupees 1 lakh. This error was found while auditing the financial statement of A Limited for 2021. So when did this error found? For example, Sumit was auditing this financial statement, or Srishti was auditing this financial statement, and they found this error in the year 2021 while auditing the financial statement for 2021. 2021 is the current year. So friends, 2021 is the current year. Suggest the correct accounting treatment in light of Ind AS 1 and Ind AS 8. So what do we require to do? So friends, in this case, what is my current year? My current year is 2021. What is my balance sheet date? My balance sheet date is 31st March 21. In this case, I have to give the comparative also. What is my previous year? My previous year is 1920. So my balance sheet needs to be prepared at 31st March 20. So friends, in this case, there is a prior period error, and this is a material prior period error. Okay. And standard says that you need to give the third balance sheet if there is a change in accounting policy or a restatement is required due to a prior period error. So friends, in this case, since there is a prior period error and this error was happened in the year 1617, so there was a prior period error. So in this case, we need to correct. Of course, we need to correct our current year. The current year number has not been published. We need to correct current year number, and we need to restate. We need to restate our previous year number as well. We need to restate our previous year number as well. We need to restate. We need to correct our previous year number as well. Sir, do we need to file the previous year financial statement once again? Answer is no. You need to correct your comparative number. Comparative number. Okay. And in comparative, the opening number are also correct, also incorrect. So you need to correct your opening number also. So how can you correct your opening balance? By giving a third balance sheet. Which third balance sheet, sir? The third balance sheet is opening of the comparative period. For this period, what is my opening date? My opening date is 1st April 2019. I need to correct the the balance sheet number. I need to correct my machinery account and cash account opening balance. I need to correct so that the previous year number could be corrected and the current year number could be corrected, right? Is it clear? So you need to restate your 31st March 19 balance sheet also, but the date should not be 31st March 19. The date should be 1st April 19. What will be the 1st April 19? The 1st April 19 is the corrected version of 31st March 19 balance sheet. I hope it is clear to everyone so far. I hope it is clear to everyone so far. Rahul, this Excel file will be uploaded on the portal as well, right? I hope this is clear to everyone. So guys, now let's move on. So what happened in this case? As mentioned by Radhika, yes, the depreciation has also corrected wrongly, also calculated wrongly, right? So if you see in 1617, what was the depreciation which needs to be charged? The depreciation need to be charged was 10,000. But what was the depreciation which has actually been charged? It has actually been charged by 1,000. So what is the short depreciation? The short depreciation is 9,000. If the correct capitalization would have been done, the P&L impact would be 10,000, not 1,000, right? So it means your reserves and surplus, your retained earnings has been increased by 9,000 in the last years. Same 17, 18, 18, 19, and same 19, 20. Because 2021 is the current year, you will correct it. Okay. So guys, we have to prepare 3 balance sheet in this case, right? We have to prepare balance sheet, current year balance sheet as on 31st March 2021, current year balance sheet as on 31st March 2021, and your last year balance sheet as on 31st March 20, and your opening of the comparative, which is 1st April 19. So it means I need to correct my 31st March 19 balance. So for correcting 31st March 19 balance, I have to correct the numbers for the last 3 years. I have to correct the numbers for the last 3 years. Okay. From 16, 17 to 18, 19. So friends, now you tell me, if everything goes right, then what should have been the net block in the 31st March 19 balance sheet? What should have been the net block? Balance of machinery as of 31st March 19, the gross block would be 1 lakh. What was the correct depreciation for the last 3 years? 30,000. So the correct net block must have been 70,000 as on 31st March 19 after 3 years. What is the existing net block? Since the capitalization happens at 10,000, so the depreciation happens at 1,000 for every year, which is 3,000. So what is the wrong net block? The wrong net block is 7,000. So guys, what is the difference? What is the difference? The difference is 70,000 minus 7,000. What does it mean? It means I need to correct my opening balance sheet. I need to correct my third balance sheet, and I need to take the cumulative impact of the last 3 years. Am I right? So today, the net block is 7,000 as on 31st March 19, but it should have been 70,000. So what should I do? I have to debit my property, plant and equipment by 63,000. Am I right? Am I right? I have to debit my property, plant and equipment by 60,000. So friends, if correct cash accounting must have been done, then your cash should be credited by 90,000 rupees. Your cash should be credited by 90,000 rupees, or I would say your cash should be credited by 1 lakh rupees. But what is the correct? This is the correct scenario. Okay, this is the correct scenario. But what is the incorrect scenario? Cash has been credited. Cash has been credited by 10,000 rupees. Right. So what is wrong? What is wrong? Your cash is short credited by 90,000 rupees. 1 lakh minus 10,000 minus 10,000. 90,000 rupees. Okay. So it means I have to debit my PPE by 63,000, and I need to credit my cash by 90,000. And one more thing I need to do, retained earnings. Guys, is there any P&L impact? Is there any P&L impact due to short charging or depreciation? The last 3 year retained earning has been debited lesser by 27,000. So in this case, on 1st April 19, I have to take this entry, retained earning debit by 27,000, machinery account debit by 63,000, and cash account needs to be credited by 90,000. Your balance sheet, your journal entry will get tallied, right? 90,000, 90,000. I hope it is clear to all of you. Srishti is asking, sir, if correction has to be made in current year, then 2 previous year financial statement needs to be modified. Yes, Srishti. Saying 2 previous year is not right. Comparative needs to be restated, and opening balance of the comparative balance sheet is also required to be given. And if the error pertains to the previous years, then in the third balance sheet, the cumulative impact needs to be taken, right? Sumit is asking, sir, why we cannot pass an entry in current year to rectify the mistakes? Sumit, in our accounting standard, we were doing like this only, right? In our accounting standard, we are taking the impact of the error in the current year only. We are not restating comparative year. we were not restating the third balance sheet. Okay, we were not presenting third balance sheet, but the global requirement of IAS 1 and IAS 8 is, in case when there is a change in accounting policy, or in case when there is a correction of error, you have to restate your comparative and you have to restate your third balance sheet also, so that the user will be able to understand what is the like to like numbers, and they will be able to understand that yes, there is an error or there is a change in the policy of the company, due to which the company has restated the comparative numbers and given the third year balance sheet. Ishan is asking, sir, if I understated amount which is of immaterial amount for suppose Reliance Limited, in that situation opening balance of financial statement needs to be rectified also, or leave it? Bang on, Ishan. So you have bang on, Ishan. Although you have asked this question, I was already supposed to take this question. So friend, if the error is not material, then these all things are not required to be done. Then you have to do the accounting treatment as simple as in the current year. For example, you have forgot to record the salary, right? Record the salary in the current year and move on. Okay. You have forgot the recording of an asset, and that is of immaterial amount. The company have an asset size of 50,000 crores, and you have forgot to record an asset worth 50 lakh rupees. It is immaterial, right? So you are not required to do all these things. Can we actually pass entry on 1st April 19? So Rahul, you are not going back in the ERP or SAP of 1st April 19. You are passing the entry in the current year only, but you have to give the reference as of 1st April 19. Okay. So Rahul is saying, if our financial, Rahul, you are right. Vikas is asking, can we get notes, Excel sheet and PPT of today as well as the last class? Would appreciate if we get it on balance sheet. Vikas, you will get it. Sir, is the new third balance sheet issued in place of all other balances issued from 16-17 till 18-19? So the third balance sheet will cover the cumulative impact. Okay, on the 1st April 19 balance sheet will cover the cumulative impact till 31st March 19. So what will be done? So guys, let me show you. In the 1st April 19, this machinery amount would be added by 63,000. The cash would have been deducted by 90,000. The retained earning would have been deducted by 27,000. The impact is clear. 90 minus 90 plus 63. Your total asset is reduced by 27,000. Your liability is also reduced by 27,000. Right? Is it clear? Then what will happen in the next year? The next year, of course, you have corrected your opening balance. Then this will flow. This will flow to the next year. The next year, what would have been the correct balance? What would have been the correct balance in the next year? The correct balance would be 70,000 minus 10,000. 60,000 would have been your PP balance. Am I right? And what is the balance which is lying in the current year? 6,000 is the balance which is lying in the current year. So how much impact should have been taken? 54,000 impact has been taken. So my current year has to be added by 54,000. But in the opening, the machine has already been debited by 63,000. It has already been added by 63,000. Now I have to reduce. What is the difference between 63 and 54? What is the difference? 9,000. What is this 9,000? This 9,000 is the current year short charge depreciation. So on 31st March 20, for the comparative year, you have to restate the P&L also. Depreciation account debit to accumulated depreciation or machinery account. Okay. So in the last year, you have to increase your depreciation expenses by 9,000. So I have used the word plus 9,000. I have used the word plus 9,000. Right? Is it clear? Is it clear, friends? I hope it is clear to all of you. Yeah? Clear? And when you plus 9,000, what will happen? What will happen? By default, the impact will come at 63 minus 9, which is 54,000. And since 6,000 was already there, so 54 plus 6 becomes 60,000. And since you have already taken a credit entry on 1st April 19. So this will flow here also, and it will be your minus 90,000. Am I right? Because it is a balance sheet. So whatever you balance in the balance sheet, the numbers are brought forwarded. In the P&L, the numbers are not brought forward. In the retained earnings, so minus 27 minus 9. As on date, as on 31st March 2020, the retained earning would have been decreased by 36,000. Is it clear? I hope it is clear to all of you. Yeah, clear. Current year is 31st March 21, which is not going to be restated. Why? It is the first year. So friends, whenever there is a major change in policy or there is a correction of prior period error, the comparative needs to be restated, and the third balance sheet, which is opening of the comparative, needs to be given. And why opening of the comparative? So that the opening balance sheet will be a corrected balance sheet, and in the opening balance sheet all the cumulative impact needs to be taken. So this is the requirement of the third balance sheet in your Ind AS 1 as well as Ind AS 8. Let me show you the real life example, then we will discuss. Okay, so I'll conclude the class in the next 10 minutes. Friends, please let me know if the balance sheet of the ONGC is visible. Friends, please let me know if the balance sheet of ONGC is visible. Is it visible, guys? Whether the balance sheet of ONGC is visible? Rahul, the period of third balance sheet is the opening date. Rahul, please understand. The balance sheet will always be prepared as on date, as at, okay, as on date. Okay. So balance sheet as at 31st March 22, balance sheet as at 31st March 21. In my example, balance sheet as at 31st March 20, balance sheet as at 31st March 21, 31st March 20, and 1st April 19. 1st April 19, it is not a period, it is as on date. And as on 1st April 19, the numbers, the correct number needs to be taken for 31st March 19 balance sheet. Okay, understood? Yeah. So friends, let me show you whatever I have told you. Let me show you that, right? Friends, let me show you the balance sheet of ONGC Limited. It is a PSU. It is a large listed company. Okay, it is a PSU. If you see the balance sheet, they have given the three balance sheet: 31st March 20, 31st March 19. It is 31st March 20 annual report. It is 1920 annual report, right? So friends, the first period is 2019-20, right? So what is the balance sheet as on 31st March 20? The comparative period is 18-19. So the comparative balance sheet is 31st March as on 31st March 2019. What is the opening date? The opening date is 1st April 18. They have given the third balance sheet as on April 1st, 2018. And they have given the star mark also, right? On the last two balance sheet, they have given star mark. So let me see the meaning of the star mark. The star mark is restated. Please refer note number 54. See, they have used the word restated, right? The comparative number and the third balance sheet. Why they have restated? Please move at note number 54. Yes. So just let me show you whatever I have taught you, whether it is applicable in the real life. Disclosure as per Ind AS 8. I have told you now that the same thing is there in Ind AS 8 also. Disclosure as per Ind AS, accounting policy, changes in estimate and errors, and Ind AS 1, presentation of financial statement. In accordance with Ind AS 8, accounting policies, changes in estimate and errors, and Ind AS 1, presentation of financial statement, the company has retrospectively restated its balance sheet as on 31st March 2019 and 1st April 2018, and statement of P&L for the year ended 31st March 2019 for the regions as stated below. So they have restated the P&L also, but P&L was restated only for the last year, only for the comparative year. Okay, understood? Let me show you the P&L also. So if you see the P&L, they have given the P&L for last year only. Only last year P&L is required. But there is a star mark. And the star mark says that restated refer note number 54. Right? Right? So in note number 54, they have said that we have retrospectively restated the number, and that is why we have given the opening balance sheet of the comparative period and we have restated the comparative period also, right? And they have written what has been done. They have given all these things. They have explained. They have changed an accounting policy of government grant, right? Retrospectively. So they have written what they have done. And as per the requirement of Ind AS 8, they have given the reconciliation of the last year balance sheets as well, so that the user will be able to understand what was presented earlier, what is the impact, and what is the restated number. So you can see they have given the reconciliation of last two balance sheets also. Sir, why not for current year? Because current year is getting presented for the first time. The last year numbers are the wrong numbers. Current year is okay, right? Current year is corrected number. They have given the reconciliation of P&L. What was previously reported, what is adjustment, what is restated. Sir, you have only talked about the depreciation impact. Is there any tax impact also? Yes, there will be a tax impact also. You can see there is a change in tax also. So whatever is the impact of the error, that has to be taken as a deferred tax income or deferred tax expenses. Okay, that has to be taken as a deferred tax income or deferred tax expense. Understood? Yeah. So that has to be taken as a deferred tax. Sir, whether we need to revise our income tax return, I don't think so. This error was happening earlier also in our accounting standard regime. We are correcting this error in the current year only. So income tax returns have been filed as per income tax provision. So are we revising our income tax return? Answer is no. So income tax return will follow the income tax provision. But as far as financial reporting is concerned, yes, there will be a tax impact also, right? We have to take the tax impact in the last year, in the comparative year, in the opening of the comparative year, right? And accordingly, we need to change last year P&L number, and accordingly, we need to change the last two balance sheet numbers, right? And the cash flow reconciliation is also needs to be given, because if the number will change in balance sheet and P&L, your cash flow will also change. So what was previously reported, what is the adjustment, and what is restated. And they have also given the note referencing. They have given the note referencing. They have explained what is the income tax number, what is the depreciation number. So they have given everything. They have explained everything, that what has been changed, right? So you can see the companies like ONGC has given this 4 to 5 page disclosure on change in accounting policy or retrospective restatement. So guys, I hope you guys are comfortable after looking at this particular disclosure. So sir, if there is any change in accounting policy or any correction of material prior period error, then comparative balance sheet, comparative P&L needs to be restated, comparative cash flow needs to be restated, corrected. Sir, earlier year, no. A comparative in the current year, comparative. Okay. And the third balance sheet is required. Why third balance sheet is required? If the impact is coming from the previous years, so that as on the opening date of the comparative year, you can you can take the cumulative impact of the last year, because balance sheet numbers are carry forwarded number. For example, you have purchased a land in 1962. That land will come in the balance sheet of 2022 also, right? If there is an asset, it will come in the balance sheet every year. Understood? So this is the new requirement of Ind AS 1 and Ind AS 8 and IFRS requirement. Okay. So life was very simple in our accounting standard. Just we need to take an entry. We need to put a separate line item, prior period item, and we need to move ahead. So guys, let me know if you have any query so far. Have you understood it very well? Have you understood it very well? Sumit is asking, what if the machine is sold? Sumit, probably if the machine would have been sold in the last year, probably the profit or loss was not right. Right? In that case, Of course, the balance sheet will not come on 1st April 19. The P&L will not come into the 1st April 19, but the cash needs to be adjusted and the retained earning will needs to be adjusted, right? Sumit is asking, sir, we have purchased the asset on 1st April 16, but for example, this asset was sold out before 31st March 19, then what will happen? In that case, Sumit, you need to see if everything was goes right, then what should have been the correct impact? For example, the cash account is still wrong. You need to correct your cash balance. Your profit or loss would have been wrong. Your retained earnings probably would not right. You have to correct your retained earning as well, right? So whatever impact would have been there, if everything was right, you have to just take the impact on 1st April 19. Understood? Sumit, is it okay? Is it clear? So guys, I have replied and responded to all the answers. So just to sum up and conclude, since morning, we have discussed a lot of aspects on division 2 to schedule 3. Then we discussed the Ind AS 1, right? We discussed the meaning of general purpose financial statement. We discussed the scope of Ind AS 1. We discussed the meaning of materiality. We discussed where Ind AS are notified. We discussed what are the component of the financial statement. We discussed the requirement of third balance sheet, right? In case of a change in accounting policy or in case of a retrospective correction in case of error, in case of prior period error, right? So friends, I have shown you the ONGC annual report also so that you will have a perfect view that yes, these kind of disclosures are there in the real life also. Okay. So thank you everyone. Thank you students. I'll take a pause for 15 seconds and if you have any query, I will be happy to take that query. Otherwise, I'll wrap up the session. Let me know if you have any query. I hope you have enjoyed the class and I hope you have understood the session very well. If you still have any query, you can write down the board of studies of ICAI and they will write down to me also and I'll respond on those queries. Thanks Radhika for the feedback. Thanks Rohan, I'm glad that you enjoyed the class. Thank you guys. Stay safe, stay happy. Thank you. Bye-bye. Take care.